Very good morning, friends. So, yesterday we were discussing the chapter of profits and gains of business or profession. We were into section 36, subsection 1. The last section which we did yesterday was section 36, subsection 1, clause number 7, which spoke about the deduction with respect to bad debts. Now, the point is, section 36, subsection 1, clause 7, we have not discussed entirely. Conditions which are required to be fulfilled for claiming deduction with respect to bad debts, those are discussed, but still there are some important points to be left which are yet to be discussed. So before I actually move on to section 36, subsection 1, clause 7 to discuss the further part of it, let us try to revise section 36, subsection 1, clause 7 right from the beginning. See, we need to learn three sections at the same time. The first one is section 36, subsection 1, clause 7. Along with that, we need to refer section 36, subsection 2. And we also need to refer section 41, subsection 4. These three sections are involved here. So, we'll start with the first one, section 36, subsection 1, clause 7. Section 36, subsection 1, clause 7 says that we will give you deduction for bad debts. Section 36, subsection 1, clause 7 says that we will give you deduction for bad debts. Deduction for bad debts will be allowed provided certain conditions which are there in section 36, subsection 2 are fulfilled. First condition is debt should be incidental to your business. So if you have a personal debt, that amount has turned out to be bad debts, then you cannot claim deduction for that. Personal transactions, if you incur any loss, those losses cannot be claimed as deduction while computing your business income. So very important point is your debt should be incidental to your business. It should be related to your business. It should be connected to your business. Then only you can claim deduction. So this is the first condition, debt should be incidental to your business. Second condition is, for second condition, we had divided the SSA in two parts. Those SSCs who are into banking business and those SSCs who are into non-banking business. SSCs who are into non-banking business, for them, the second condition says that such debt should have been taken into account while computing income of the SSC. Such debt should have been taken into account while computing income of the SSC means that the entry should have been debtors account debit to sales account. One effect should have gone to income. So when one effect can go to income, when you pass an entry debtors account debit to sales account. I gave you an example yesterday saying that, say for example, you gave a deposit to your supplier and that supplier ran away with your deposit. In that case also, there is a loss. In that case also, you can write off that deposit amount to your profit and loss account, but you can't claim deduction in section 36. Subsection 1, clause 7, because when you gave deposit to your supplier, what entry you had passed was deposit with supplier account debit to bank account. In this entry, one effect has not gone to income, and since one effect has not gone to income, condition number 2 is not fulfilled. And since condition number 2 is not fulfilled, you can't claim any deduction in section 36, subsection 1, clause 7. So once again I repeat section 36, subsection 1, clause 7, read with section 36, subsection 2. Second condition says that in case of a non-banking business, one effect should go to income, meaning thereby while computing income of the SSC, one effect should go. Whereas in case of banking business, such debt should represent money lent in the ordinary course of banking or money lending business. In case of banking business, the second condition says that such debt should represent money lent in the ordinary course of money lending or banking business. So definitely when you talk about the bank is into banking business, so bank will provide loan to its own customers, and while it is giving loan to customers, they would pass an entry, loan to customer account debit to bank account, loan to customer account debit to bank account. So definitely that loan to customer would appear in the balance sheet asset side of the bank. So it is representing money lent in the ordinary course of money lending or banking business. This was the second condition, friends. Then the third condition was debt should be actually written off to the books of accounts. Meaning thereby, if you just pass an entry for RDD, reserve for doubtful debts, then you can't claim any deduction. Say for example, you have sold goods to customers on a credit basis, so you passed an entry debtors account debit to sales account. Once you have passed an entry debtors account debit to sales account, thereafter if you feel that customer may or may not pay, in that you may create an RDD by passing an entry profit and loss account debit to reserve for doubtful debts account. If you pass an entry for RDD, that cannot be claimed as deduction. Why so? Because it is not an actual loss, it is an estimated loss, it is a probable loss. That loss may or may not occur. Section 36 subsection 1 clause 7 gives you deduction for actual loss, not for the estimated or the probable loss. Therefore, third condition says that debt should be actually written off in the books of accounts. What do you mean by written off in the books of accounts? The entry to write off should be bad debts account debit to debtors account, and then the second entry should be profit and loss account debit to bad debts account. So one effect should go to the debtors account. If one effect goes to debtors account, then only for bad debts you can claim deduction. This was the third condition. Fourth condition was very simple. Fourth condition says that the business in respect of which bad debts is incurred, that business should be continued during the previous year. Yesterday I gave you an example saying that I was doing a grocery business. In that I had incurred a lot of losses in the form of bad debts. Therefore I stopped the grocery business and I moved on to clothing business. So in that case I have stopped my business. I have now moved on to separate line of business. The existing business, grocery business, is totally stopped. So point number 4 condition is not fulfilled. Condition 4 says the business in respect of which bad debts is incurred should be continued during the previous year, meaning thereby if you discontinue the business, you can't claim deduction for bad debts. Hopefully friends, all these 4 conditions are very much clear to you. I have revised all these 4 conditions. In your notes, we are on which page? We are on page number 131. We are on page number 131 in your notes. In that notes, these 4 conditions A, B, C and D are 4 conditions I have revised for you. So condition A, B, C and D, these are revised. Important points to be noted. First important point we have already discussed yesterday, saying that say for example, I have incurred a loss in the form of bad debts in my business. Because of huge loss in the form of bad debts, I got a heart attack. I was very tensed because of incurring huge losses and I got heart attack. So I have sold a lot of goods to my customers on a credit basis. They were not paying me. I got a heart attack. So I died and my business will be taken over by my child. So my child has inherited my business. Yes, inherited my business. So now he is passing an entry, bad debts account debit to debtors account. He is writing off the debt. Can he claim deduction? Definitely he can claim deduction, but why such question is arising first of all? Because the SSE has changed. Earlier I was SSE, now my child is an SSE. So SSE has changed. Therefore the question arises whether he can claim deduction for bad debts or not. So there are a lot of case laws in different high courts. Those cases, decision was given that even the successor can claim bad debts in respect of debt which was created by the predecessor. So I am a predecessor. I created the debt by passing an entry debtors account debit to sales account. And later on I died. My business was taken over by my child. Now he has passed an entry bad debts account debit to debtors account. Can he claim deduction? So provision says yes, definitely he can also claim deduction. So point number 1 says deduction is allowed even to the successor in business. So deduction is allowed to the successor. Even successor can claim the deduction. Point number B also we have already discussed yesterday. Point number B also we have already discussed yesterday. saying that it is not necessary to prove that the debt has become bad. It is not necessary to prove that debt has become bad. So, without proving that I have incurred bad debts, just by passing an entry in the books of accounts, just by writing off the debt in the books of accounts, I can claim the deduction. There is no need for me to prove that I had incurred bad debts. Now friends, let's move on to third important point. Third important point is nothing but it is proviso to section 36 subsection 1 clause 7. It is made applicable only with effect from assessment year 16-17. Before I try to explain you the proviso, let us move on to this and let us read the first 4 lines which are underlined here. This says that if the debt was taken into account for computing income, means debt was taken into account for computing income, but was not recorded as income in the books of accounts owing to accounting standards, and later it become irrecoverable. This is allowed as deduction even though it is not actually written off in the books of accounts. For example, see, while I compute my income under income tax, that debt is taken into account while computing income. This debt is taken into account. This debt is taken into account for computing income. So when it comes to income tax, that debt was taken into account for computing the income. Now think about the accounts. Books of accounts. See, I am not the champion of accounting standards. You might have learned a lot of accounting standards, or maybe you will be learning accounting standards in your syllabus. But say for example, because of some accounting standard, income is not recognized. Income is not recognized. Means income is not taken into books of accounts. Because of some accounting standard, because of the requirement of the accounting standard, that debt is not taken into account. Means it is not taken into books of accounts. Means your books of accounts do not reflect this debt. Now the point is, the condition says that debt should be actually written off in the books of accounts. If it is not appearing in the books of accounts, how can you write off the debt? It is not appearing in your books of accounts, so you cannot write off. It is not possible to write off. If you want to write off something, first of all, it should appear in your books of accounts. So this point says that there might be some debt which would have been considered as your income while computing your income under income tax, but as per the accounting standard requirement, that debt is not taken into account while computing income. Therefore, that is not forming part of your books of accounts. And since it is not forming part of your books of accounts, it is not possible for you to write off such debt. Such debt, if that turns out to be bad debts, then we will give you deduction for bad debts even without writing off that debt. Why? Without writing off? Because it is not appearing in the books of accounts and it is not possible for you to write off. Now see, don't ask me questions relating to accounting standards. I am not a champion or I am not a knowledgeable person when it comes to accounting standard. But when you learn accounting standard, you will come across say accounting standard 9, revenue recognition. So sometimes we recognize the revenue in future, not in the current period. So in such instances, under income tax, income is already recognized, but under the accounting, income is not recognized. So in future, if that turns out to be bad debts, you can claim deduction even without writing off the bad debts. So what it says, point number C says, if debt was taken into account for computing income is where? Under the income tax, but was not recorded as income in the books of accounts owing to accounting standard, and later it became irrecoverable. So later that has turned out to be a bad debts. This will be allowed as deduction even though it is not actually written off in the books of accounts. See, even if you intend to write off, it is not possible to write off because that debt is not appearing in your books of account. Because of accounting standard, you have not recorded that income in the accounts. So debt is not created. Since debt is not created in your books of accounts, there is no question of writing off. So here income is not recognized means debt is not created. Debt is not created, therefore there is no question of write-off. There is no question of write-off. So proviso 2 says that without writing it off, we are going to give you deduction. So section 36 subsection 2, the third condition said that debt should be actually written off. So this debt, which was not created in our books of accounts, it was just considered as an income while computing income under the income tax. Since it is not appearing in our books of accounts, there is no possibility that you can write off, and this debt without writing it off, we are going to give you as deduction. Hopefully friends, this condition is very much clear to you. This point is very much clear to you. So this point number C is also over. Just below that, see, this is the heading I have given, and then we have paragraphs. So in detail it is explained. You can just refer to it. Thereafter, if you are having any doubt, you can definitely ask the doubt. Now with this we have completed the discussion with respect to deduction of bad debts. Now along with that, we need to also discuss section 41 subsection 1, which talks about bad debts recovered. Which talks about what? Which talks about bad debts recovered. See friends, bad debts recovered is taxable in section 41 subsection 4. Bad debts recovered is taxable where? It is taxable in section 41 subsection 4. See, now there are two possibilities. Right now we are discussing which section? Section 41 subsection 4. This talks about what? This talks about bad debts recovered. This is exactly opposite to bad debts. Bad debts was a loss for you, and hence you asked for the deduction, and we gave you deduction in section 36 subsection 1 clause 7, definitely subject to fulfillment of certain conditions. Now bad debts recovered is not a loss. Bad debts recovered is a gain for you. Bad debts recovered is a gain for you. Whatever bad debts you had written off, subsequently your customer pays money to you. In that case, we say it is a bad debts recovered. This bad debts recovered is a gain for you. So the question arises whether this will become taxable or not. So we need to discuss that whether bad debts recovered will become taxable or not. So there are two possibilities. Listen to me very carefully. There are two possibilities. There are two possibilities. Possibility number 1, if bad debts, I am not talking about bad debts recovered, here I am talking about bad debts, If bad debts was allowed as deduction in the past years, If bad debts was allowed as deduction in the past years means what? You had sold the goods to customers on a credit basis, some of the customers did not pay you, so money has become irrecoverable for you. And that amount is actually written off in the books of accounts, that is claimed as deduction, and the income tax officer has allowed you the deduction. What is the consequence of allowing deduction? If the deduction was allowed in the past year, means if deduction is allowed, your PGBP income will be lower. If your PGBP income is lower, your total income definitely will be less, and your tax liability will also be less. In other words, on that amount you have not paid any tax in the past years. So the question is, if right now that bad debts are recovered, Should it become taxable? Yes, it should become taxable. Why it should become taxable? Because in the past year deduction was allowed to you. Since deduction was allowed to you, tax is not levied on that amount. So in the current year, if it is recovered, bad debts recovered will become taxable. So your conclusion is what? Bad debts recovered will become taxable in this case. Bad debts recovered will become taxable in this case. Hopefully friends, this is very much clear to you. Very simple it is. Bad debts recovered is taxable. So it is very simple. If the deduction for bad debts was allowed, then income would have been lower in the past years. So if right now the bad debts is recovered, definitely it needs to be taxed. What should be the second possibility? Second possibility is if bad debts was not allowed as deduction. Bad debts was not allowed as deduction in the past years. Means in the past years you had sold the goods to the customers on credit basis. You realized that this money will become irrecoverable. It has already become irrecoverable. You have written off that debt in your books of accounts. You have written off your debt in the books of account, but due to certain reasons, whatever may be the reason, income tax officer did not allow you deduction. So for this bad debts, deduction was not allowed in the past. If deduction was not allowed in the past, what is the consequence? If there is a loss to you, that loss you might have debited to your profit and loss account. In accountancy, that loss is debited to your profit and loss account. But while I compute the PGBP income under the head, while I compute the PGBP income in income tax, I say that I am not going to give you a deduction. So income tax officer says that he is not going to give you a deduction. What is the consequence? You have debited the loss to your profit and loss account, and income tax officer denies you the deduction. If income tax officer denies you deduction, then whatever loss is debited to your profit and loss account, that will be added back to your net profit while computing your PGBP income. Whatever expenditure is debited to profit and loss account or whatever loss is debited to profit and loss account, if deduction is not allowed for that expenditure or deduction is not allowed for that loss, what effect we will give? That will be added back to your net profit while computing your PGBP income in income tax. So my point is, for whatever reason, forget about what was the reason behind it, for whatever reason, if income tax officer had denied you the deduction for bad debts, what would have been the consequence? If the deduction for bad debts was denied to you, definitely don't you feel your PGBP income would have been higher? If your PGBP income would have been higher, then your total income also would have been higher and your tax liability also would have been higher. In other words, if the deduction for the bad debts was denied to you, as a result of which your income might have went up, on that amount you might have already paid the tax. And since you have already paid the tax, in future when the bad debts is recovered, it should not be taxed once again, because if you levy the tax, that would amount to double taxation. So what is the final conclusion here? In this case, bad debts recovered will not be taxed. It will not be taxable. It will not be taxable. Is that very, very clear? So it is very, very simple. 2-line small conclusion. If the bad debts deduction was allowed to in the past years and subsequently bad debts are recovered, that will become taxable. If the bad debts deduction was not allowed to in the past years, then if the bad debts is recovered in the current year, that will not become taxable. Now friends, let me add one more point here. You know that income under the head PGBP is calculated based on the method of accounting followed by SSC. But to that provision or to that rule, there is an exception. There is an exception. And that exception is section 41 subsection 4. What is that? Bad debts recovered. Here we say that bad debts recovered will become taxable in the year in which it is recovered. So in the year in which it is recovered, in that year it will become taxable. So irrespective of whatever method of accounting you are following, if there is a bad debts, thereafter that bad debts are recovered, it will become taxable in the year of recovery. It will become taxable in the year of recovery. Now friends, let us go through this section 41 subsection 4 in your notes. In your notes, we are on page number 132. We are referring to this bad debts recovered. Recovery of bad debts. Point number A says bad debts recovered are taxable in the year of recovery. They are taxable in the year of recovery, meaning thereby they are taxable on receipt basis. See, even if SSC is following mercantile system accounting, this will become taxable on receipt basis. So I can definitely say that this is an exception to the general rule. General rule says what? Your income under that PGBP is taxable based on the method of accounting followed by SSC. But to that general rule, there is an exception. Bad debts recovered will always become taxable in the year of recovery. It will always become taxable on receipt basis. So this point 1 is over. Point 2. Forget about point B right now. Let me move on to point C. I have already explained you point C. What it says, bad debts recovered are taxable. Bad debts recovered are taxable only if deduction for bad debts was allowed to the SSC. If deduction for bad debts was not allowed to the SSC, then bad debts recovered cannot be taxed. This I have already explained you, point number C. Now point number D. Point number B. Point number B says bad debts recovered are taxable even if the business is discontinued. See, there are contradictory provisions. In bad debts, the provision was different. In bad debts, recovered provision is different. How different it is? In bad debts, we said that a successor can claim deduction for the debt which is created by the predecessor. So, successor can claim the deduction for the bad debts. And here what will happen? I'll explain you by writing. I'll write something to make you understand. What is the difference in the provisions with respect to bad debts and bad debts recovered? That is what I'll make you understand. Bad debts versus bad debts recovered. Bad debts versus bad debts recovered. These are the important points which I am discussing with you. If you want to write, definitely simultaneously you can write. See, bad debts, one of the condition was the business in respect of which the bad debts is incurred should be continued during the previous year. So, if the business, there are two possibilities. Business is continued, and second possibility is business is discontinued. What will happen if the business is continued? Bad debts deduction is allowed. Bad debts deduction is allowed. If the business is discontinued, then bad debts deduction is not allowed. Bad debts deduction is not allowed. This part I have already discussed with you. Now I want to discuss similar point for bad debts recovered also. Similar point for bad debts recovered. So here also there are two possibilities. Business is continued or business is discontinued. Question is whether the bad debts recovery will become taxable or not. So here the provision says that irrespective of whether the business is continued or business is discontinued, the bad debts recovery is going to be taxed. Bad debts recovered will become taxable to you. So bad debts recovered are always taxable, irrespective of whether the business is continued or discontinued. So you can compare here, and you can see that there is a difference between the provision of bad debts and provision of bad debts recovered. Here we are saying that if the business is discontinued, deduction for bad debts is not allowed. And in case of bad debts recovered, it will become taxable even if the business is discontinued. Hopefully, friends, this point is very much clear to you. This point is very much clear to you. I have drawn a small flow chart here. Now, Deva has asked me a question saying that, sir, if bad debts deduction was not allowed in section 36 subsection 1 clause 7, why the SSC did not go to section 28 clause 1 general section and claim the deduction? Because whenever you have a specific provision, you can't go to the general provision. See, why the government would make this specific provision? Because government had an intention of putting certain conditions for raising deduction. So, for bad debts deduction, government had an intention to put certain conditions. In section 28, there are no conditions. But in section 36, subsection 1, clause 7, for claiming deduction of bad debts, you have multiple conditions which are given in section 36, subsection 2. So, if you don't fulfill the conditions of the specific section, you can't say that I'll go to the general section and claim the deduction. That is not possible. That will not be allowed, because specific rule will always prevail over the general rule. Now, let me tell you that this point which I have explained you, saying that deduction was denied by the income tax officer, as of now in practical life, no income tax officer would deny your deduction. Why so now? In the past years, few years back, for claiming deduction for bad debts, you were required to prove that those debt has become bad. As of now, there is no such provision. So, without proving that your debt has become bad, you can claim the deduction. So, in the past years, SSC was required to prove that debt has become bad. If he was unable to prove, then the deduction was denied. If he proved, then only deduction was allowed to him. But as of now, there is no such provision. So, you can claim the deduction for bad debts without proving that bad debts has occurred. You have to just write off and claim the deduction. So, such possibility would not arise as of now. But if at all examiner is asking you in the question, then you should be in a position to give the answer, and accordingly you should give the answer. Is that very, very clear? Bad debts and bad debts recovered, we have discussed one point. Continuity or discontinuity of business. Definitely discontinuity of business will not affect the taxability of bad debts recovered. Once again, I move on to the notes. Here I am saying point number B. Point number B says what? Bad debts recovered are taxable even if the business is discontinued. Bad debts recovered are taxable even if the business is discontinued. Point number B is over. Point number C, bad debts are taxable only if the deduction was allowed for the bad debts. This is also over. Now let's move on to the last point with respect to bad debts recovered. How do we ascertain the taxable amount? Let me take you through the example to make you understand how do you ascertain the taxable amount. Say for example, there is previous year 18-19. In previous year 18-19, you had claimed a deduction for bad debts. Bad debts deduction was claimed. I am bifurcating this into three parts, basically three cases. Case 1, case 2, case 3. So, if you want to write, definitely you can write along with me. For example, bad debts amount. I will tell you the bad debts amount. bad debts equal to say 20,000 rupees. Bad debts is 20,000. Now case 1 I am saying you that deduction allowed was 20,000. Deduction allowed was 20,000. See, why I am discussing this is the provision has changed, but if the examiner gives you the adjustment in the question based on the old provision, then you should be in a position to solve. He should not ask such, he should not create such a situation which is based on the old provision, but sometimes the examiner would pick up the question from the past examination only, so he may forget to change the adjustment. In that case, we should be in a position to answer. So, I am telling you that there are three possibilities. Possibility number 1, you had incurred a bad debts of 20,000 and deduction was allowed for the entire 20,000 to you. Second possibility, deduction was not allowed. Deduction was totally denied to you. Deduction was totally denied. And the third possibility is deduction was allowed for say 12,000 rupees. So you incurred a bad debts of how much? 20,000 rupees. But deduction was allowed only for 12,000. In other words, deduction was not allowed for how much? For 8,000, deduction was not allowed. For 8,000, deduction was not allowed. Now, listen to me very carefully. Since we have created three possibility for bad debts, we will also create three possibility for bad debts recovered. Now, say for example, the previous year is 2021. In 2021, bad debts recovered are say 18,000 rupees. Bad debts recovered are 18,000. Now the question is, what would be the treatment of this 18,000? How much bad debts you had incurred? 20,000 rupees. But how much is recovered? Only 18 is recovered as of now. So the question is whether this 18 will become taxable or not. Whether this 18 will become taxable or not. It all depends upon whether the deduction was allowed to you in the past or not. So, I am trying to match case to case. The three cases of bad debts would be compared with three cases of bad debts recovered. For example, look at the first case. In the first case, you incurred a bad debts of 20,000. Entire 20,000 was allowed to you as deduction. Now, subsequently, in the future year, that is previous year 2021, how much you have recovered? 18,000 is recovered. Should it become taxable? Definitely yes, it should become taxable because deduction was allowed to you in the past. So this 18,000 should become taxable. This 18,000 is taxable. Second case. Second case, 18,000 is recovered by you. Now the question is whether 18,000 should become taxable. If you look at the second case of bad debts, you had incurred bad debts of 20,000, but that bad debts was not allowed to you as deduction in the past year. If the bad debts was not allowed to you as deduction in the past year, your income of the past year might have already increased and you have paid more taxes on that amount of income. Means that amount is already taxed. That amount is already taxed in the past year itself. Therefore, it should not be taxed once again. Therefore, it should not be taxed once again. So, this 18,000 is not taxable. This 18,000 is not taxable. Hopefully, friends, this is very much clear. I am making case to case. See, generally teachers won't discuss this provision in so much detail. I am discussing intentionally because I have seen questions being asked from this provision. So, case 3. Now, case 3, you have recovered 18,000. You have recovered how much? 18,000 you have recovered. Now, the question is whether this 18,000 should become taxable or not. It all depends upon whether the deduction was allowed to you in the past or not. Now, if you refer to the bad debt story in the past, there was a bad debts of 20,000 whereas you were allowed deduction for 12,000. For 8,000, deduction was not allowed to you. For 8,000, deduction was not allowed to you. As a taxpayer, what you would claim? As a taxpayer, or let me continue this on the next page. I'll continue this on the next page. This case 3 I have continued here. Case 3. Case 3 also I am dividing 3 parts. Number 1, how the department would think. This is from department's point of view. This is from department's point of view. Means how the department would think. Tell me how much amount is recovered by you? 18,000 is recovered. So now the question is whether this 18,000 should be taxed to you or not. So the point is whether the deduction was allowed to you in the past or not. So if you look at the past story, out of 20,000 of bad debts, deduction was allowed to you for 12,000. It was not allowed to you for 18,000. For 8,000, deduction was allowed to you for 12,000. It was not allowed to you for 8,000. So income tax department will say that out of this 18,000, for 12,000, deduction was allowed. So right now, this should become taxable. And for 8,000, deduction was not allowed. But this 18, out of 18, you have taken 12 to the left hand side. So what will be left is 6,000. For this 6,000, deduction was not allowed. Therefore, this should not become taxable. This should not become taxable. Basically, 18,000, this amount recovered, bad debts recovered. Officer will try to tell you that this is forming part of that amount which was allowed to you as deduction. Therefore, it will become taxable. So, first of all, he will allocate to which portion for which deduction was allowed to you. This is the manner in which department would be thinking. What would be the manner in which SSC would be thinking? From SSC's point of view. From SSC's point of view. SSC will say that I have recovered 18,000 right now. Now out of 18,000, how much is taxable, how much is not taxable? SSC will claim that this 18,000, this 18,000 includes this 8,000 for which deduction was not allowed. For this 8,000, deduction was not allowed. Not allowed means it was already taxed. So once again, this 8,000 should not be taxed. So what SSC will claim, out of 18,000, 8,000 deduction was not allowed. Means it is already taxed. Right now, it should not be taxed. So out of 18,000, SSC would like to take 8,000 to that portion which was not allowed as deduction. Therefore, tax will not be levied right now. And remaining 18 minus 8, that is 10,000. 10,000, he would claim that for this 10,000, deduction was allowed to me in the past. So this is taxable right now. Now if you look at these two things, look at these two situations. There are two views. Number one, view of the department and view of the SSC. As per the view of the department, what is going to become taxed? 12,000 will be taxable. But as per the view of the SSC, what will be taxed? 10,000 will be taxed. So department will think from their point of view, SSC will think from his point of view. Now the question is, which point of view is correct? Which point of view is correct? Law is silent on this. Law is totally silent on this. And whenever law is silent, then the interpretation which is beneficial to the SSC should be taken. Whenever the law is silent, then the interpretation which is beneficial to the SSC should be taken. So we would be taking up this interpretation. In that case, 10,000 will become taxable. 10,000 will become taxable. Hopefully friends, this is very much clear to you. So I have simply explained you one thing, or we can have a conclusion in a summarized manner, saying that bad debts recovered, if it was allowed 2 years deduction, then it can become taxable right now. If bad debts was not allowed 2 years deduction, bad debts recovery cannot be taxed. If at all bad debts was partly allowed 2 years deduction and partly not allowed 2 years deduction, then that part for which deduction was not allowed, that can't be taxed, and that part for which deduction was allowed, that will be taxed. Hopefully friends, this bad debts and bad debts recovered is very much clear to you. Now someone is asking me to explain proviso 2 once again. I am very much sure this bad debts and bad debts recovered is very much clear to you. If at all any one of you are having doubts, you should immediately drop the message. I have explained you much detail by taking different examples, and while I explain you in these lectures, I will be writing a lot of things. So if you want to write along with me in the notebook, you can write. See that proviso 2, I have already explained you, but I will quickly go through it. Proviso 2 you will come to, you will understand in a better manner only when accounting standard is taught to you. See, then in accounting standard we have accounting standard 9, which talks about revenue recognition. Revenue recognition means when to recognize the revenue in the books of accounts. When to recognize the revenue in the books of accounts. So in income tax, income is taxable, PGBP income is taxable based on the method of accounting followed by SSC. House property income is taxable on accrual basis. It may happen that for certain income, the taxability criteria in income tax and revenue recognition criteria in accounts are different. As per accounts, revenue might be recognized in future period, but as per income tax, revenue might be recognized and it would be taxed in the current period. So we are talking about such a point, wherein the accounting provisions or the accounting rules are different and the income tax rules are different with respect to recognizing the revenue. So in section 36 subsection 2 proviso 2, we are talking about a situation wherein accounting standard has asked you to recognize the revenue in future. So in the current period, you have not recognized any revenue. So in current period, you have not created any debt. You have not passed an entry debtors to sales in the current period. Whereas income tax provision is asking you to recognize the revenue. So what you have done, while filing your income tax return, you might have paid a tax on that income. But when it comes to passing the entry in the books of accounts, you have not passed any entry in the books of accounts. So debtor is not created in your books of accounts. If debtor is not created in books, how can we write off? How can we write off? If the debtor is not created in the books, we can't write off. Therefore, section 36 subsection 2 proviso 2 says that in certain situations, we will allow you deduction for bad debts even without writing it off. Why it says so? Because it is not possible to write off. Because it is not possible to write off because there is no debt in your books of accounts. Income was just declared in your income tax return. It was not recorded in your books of accounts, so it is not possible to write off. Hopefully friends, this is very much clear now. Dikshit, have you understood this? Only for you I have taken up once again this. So with this, the discussion of bad debts and bad debts recovered is over. Discussion of bad debts and bad debts recovered is over. Now friends, we move on to section 36 subsection 1 clause 9. Section 36 subsection, yes, I got a message from Dikshit saying that, yes sir, I have understood. Very good, thanks. Section 36 subsection 1 clause 9 gives the direction for expenditure on promotion of family planning among employees. See, don't ask me to give you an example on this. Don't ask me to give an example. So if first of all, we are in which section? We are in section 36 subsection 1 clause 9. Section 36 subsection 1 clause 9. This is giving reduction for what? Family planning expenditure. No, government is not giving reduction to everyone. If you are doing family planning, then government is not going to give you any deduction to you. We say that, see, if the population of the country is very high, then limited resources would not be enough to feed the entire population. So population should be within some range. It should be limited to certain extent. If the population is reasonable enough, then the country would have adequate resources to feed that population, adequate food, adequate natural resources. If the population goes beyond a particular level, then everywhere there would be scarcity of foods, scarcity of natural resources, etc. So government has given deduction saying that if the company incurs any expenditure on family planning, for guiding their employees for family planning, in that case company can claim deduction. Other SSC cannot claim deduction. You can't say that I have incurred certain expenses on family planning, give me deduction. See, if you are doing a job, you are getting a salary. Your income is taxable under that salary, and this deduction is allowed under that PGBP. So everyone cannot claim deduction. Only company can claim deduction. So first of all, family planning expenditure. Question 1 is who can claim deduction? Who can claim deduction? Possibility number 1, if SSC is company. If SSC is company, and possibility number 2, SSC is not company. When we say SSC is not company, meaning thereby SSC might be either individual, HUF, firm, association of person, body of individual, etc., etc., etc. In that case, we say that deduction is not allowed. Deduction is not allowed. In other words, deduction is allowed only when the SSC is a company. Now, if SSC is a company, they might incur certain expenditure for giving guidance to their employees with respect to family planning. That expenditure we can divide in two parts. Number 1 is revenue expenditure. Number 1 is revenue expenditure. And number 2 can be what? Number 2 can be definitely capital expenditure. The manner of allowing deduction for the revenue expenditure is different, and manner of allowing deduction for capital expenditure is different. First of all, who can claim deduction? Only company can claim deduction. Other SSCs cannot claim deduction. Revenue expenditure, deduction will be allowed in the year in which expense is incurred. Deduction is allowed in the year in which expenditure is incurred. So basically deduction will be allowed on accrual basis. Right away in the first year in which you have incurred the expense, you claim the deduction for the entire amount. Very simple. What about the capital expenditure? Capital expenditure also deduction will be allowed, but the manner of claiming deduction is slightly different. How deduction will be allowed? The provision says deduction will be allowed in 5 equal annual installments. Deduction will be allowed in 5 equal annual installments. See, in the chapter of income from house property, deduction was allowed for pre-construction interest. In the similar manner, deduction was allowed in 5 equal annual installments. In the chapter of income from house property, deduction for interest on pre-construction period was allowed in 5 equal annual installments. In the chapter of PGBP, in section 35D, preliminary expenses, section 35 DDA, in both those sections, deduction was allowed in 5 equal annual installments. Similarly, here also, deduction is allowed to the company for family planning expenditure. If the expenditure is in the nature of capital expenditure, deduction will be allowed in 5 equal annual installments. So friends, with this section 36 subsection 1, clause number 9 is over. Now, let us go through this once very quickly from your notes. Page number 132. Point number A says deduction is allowed only to company. Point number B says revenue expenditure, 100% deduction is allowed in the year in which expenditure is incurred. Point number C, capital expenditure deduction is allowed in 5 equal annual installments. Point number D says no double deduction. No double deduction means what? If you have incurred a capital expenditure on family planning, then we are allowing reduction in 5 equal annual installments in section 36 subsection 1 clause 9. So the point is, can you capitalize that asset? Can you capitalize and claim depreciation also for that capital expenditure? Answer is no, because that would amount to double deduction. That would amount to double deduction. For example, say for example, there is a very big company belonging to Tata Group. In that company premises, they have set up one small room, which is called as a counseling room for family planning. One consultant is appointed. That consultant will be paid a salary, and that consultant every day he will catch 25 people, 25 employees from the company, and he would counsel them. So whatever salary is being paid to that consultant is a revenue expenditure, and whatever cost is incurred for setting up that room, in that room there might be a projector, there might be AC, etc. So all this is capital expenditure, and this capital expenditure is allowed to you as deduction in 5 equal annual installments. So you can't go and claim the depreciation also. Otherwise that would tend to amount to double deduction. Therefore point number D says double deduction will not be allowed. Double deduction will not be allowed. Point number E right now I am not discussing. I will discuss with you in the chapter of set off and carry forward of losses. Set off and carry forward of losses, we will take up this point. Otherwise right now I can explain, but it will take a lot of time. Unnecessarily time will be consumed, and I will also face difficulties in explaining, you will also face difficulties in understanding. So this is related to set off and carry forward of losses chapter, we will take up there only. Now friends, let us proceed to the last 2 points of section 36 subsection 1, that is clause number 15 and clause number 16. Once we complete this, section 36 subsection 1 will come to an end. Section 36 subsection 1 clause number 15. So section 36 subsection 1 clause 15 talks about what? This talks about something called as securities transaction tax. It talks about what? it talks about securities transaction tax. Now the question is, what do you mean by securities transaction tax? Friends, whenever you do any transaction in securities, means either you purchase the securities or you sell the securities, you always purchase or sell the securities through the broker and through the stock exchange. When I say securities, the word security also by default includes the word shares. So, when you are selling the securities or you are acquiring the securities through the stock exchange, then you have to pay a tax called as securities transaction tax. You have to pay a tax called as securities transaction tax. Now the point is, here there are two possibilities. Possibility number one, if those securities are held as stock in trade, say for example on a daily basis you are trading in shares or you are trading in securities, you purchase the shares of Reliance today and you sold it tomorrow, or you purchased today morning and you sold it today afternoon itself, then we can say that those securities are stock in trade for you. You are dealing in those securities. So when you deal in these securities, you carry out the transaction through a stock exchange and you pay the securities transaction tax. That securities transaction tax will be allowed to you as deduction. Under the head PGBP. Under which section? Definitely under section 36, subsection 1, clause number 15. So securities transaction tax is allowed to as deduction provided those securities are held by you as stock in trade. So you are dealing in those securities on a daily basis, then those securities are held by you as stock in trade, and whatever securities transaction tax you might have paid to the stock exchange, that securities transaction tax will be allowed to you as deduction while computing your business income. On the other hand, the right hand side part I am discussing right now with you, but this will be discussed in detail by taking a numerical example when we move on to the chapter of income from capital gain. Right now I am just giving you an idea. If these securities are held as capital asset, when can we say that securities are held as capital asset? Na? Those securities are not stock in trade for you. Those securities are investments for you. If those securities are long-term investments for you, then we say that securities are held as capital asset. If there is a profit or loss on sale of such securities, if there is profit on sale of such securities which were held by you as investment, then that profit cannot be taxed under that PGBP. That profit will be taxed under that capital gains. And if there is a loss while dealing in securities and those securities were held by you as a investment, then that loss also deduction can be claimed under the head capital gains. So if you are holding the securities as capital asset, you are holding the securities as investments, then if there is a gain, it is taxable under the head capital gains. If there is a loss, then also capital gain head, you will claim set off. Set off will be allowed. Now friends, since you are dealing in securities and since you have acquired the securities, you have sold the securities, you might have earned the profit or you might have incurred the loss, but since you are holding the securities as investment, your income as well as loss both are taken to the head of capital gain. Therefore, this securities transaction tax also go to the head of capital gain. So that securities transaction tax should not come here in the chapter of PGBP, it should go to the chapter of capital gain. Now I am telling you that when you take it to the chapter of capital gain, deduction will not be allowed. Deduction will not be allowed. So what is the consequence of not allowing deduction? Definitely your income is going to increase. But I'm not going to take an example as of now to explain you what is the consequence in detail. I'll be taking the example when we move on to the chapter of capital gain. So for the time being, you just understand that if the securities are held as stock in trade, then whatever securities transaction tax you paid will be allowed to as deduction while computing your PGBP income in section 36 subsection 1 clause number 15. Whereas on the other hand, if the securities are held as investments, then securities transaction tax effect will be there in the chapter of capital gain, but the chapter of capital gain says that deduction will not be allowed for securities transaction tax. Hopefully friends, this is very much clear to you. With this we have completed section 36 subsection 1 clause number 15. So 36(1) clause 15 is over. Now we also have section 36 subsection 1 clause 16. The explanation of section 36 subsection 1 clause 16 is on the same lines. So I will not write everything once again. I'll just explain you without writing anything. So section 36 subsection 1 clause number 15 spoke about the securities transaction tax, whereas section 36 subsection 1 clause 16 talks about the commodities transaction tax. See, the way we are having we are having share market or the stock exchange for dealing in securities. Similarly, we also have an exchange for dealing in commodities. Say for example, you are dealing in gold. If you want to buy 1 kg of gold at a price of say 50,000 rupees per 10 gram, if you buy 1 kg, it will be worth 50 lakh rupees. You don't have an intention to buy the gold and keep it in your house. Your intention is to buy the gold and sell it the moment price rises even by 500 or 1000 rupees. If that is the case, then you are buying the gold as a commodity with the intention to earn the profits. So that gold is held by you as stock in trade. So the way I told you now, you can become a dealer in shares. You can acquire the shares on a daily basis, and you can sell the shares on a daily basis. Those shares will be considered for you as stock in trade. Then you can claim deduction for securities transaction tax. Similar to that, we have commodity exchange. We have a commodity exchange if you want to deal in commodities. If you want to purchase the commodities or you want to sell the commodity, you can purchase or sell the commodity through an exchange called as commodity exchange. Through the commodity exchange, you can deal into gold, you can deal into silver, etc., etc. Now, for example, you have acquired gold from the commodity exchange. So whenever you carry out a transaction on a commodity exchange, you have to pay tax called as commodities transaction tax. The way you pay securities transaction tax if you carry out a transaction through stock exchange in shares and securities, similarly you have to pay commodities transaction tax if you are carrying out a transaction through a commodity exchange in respect of commodities. Now say for example, from somewhere you got a tip that the price of gold is going to increase. So you decided that you want to make the most out of this opportunity and you bought 1 kg of gold. See, if you buy 1 kg of gold from a commodity exchange, if you buy for a temporary period of time, you are not required to pay the entire amount of value of gold, that is 50 lakh rupees. You will be required to just pay the margin money because you are a dealer. Your intention to purchase the gold is to take the profit due to the profit which may arise due to the increase in the price of the gold in a short span of time. So you have bought the gold from the commodity exchange today, and just after 5 days, the price of gold went up from 50,000 per 10 gram to 51,000 per 10 gram. So what you will do? You will sell up the gold. The net amount of 1000 rupees per 10 gram you have earned. So you are dealing in commodities as a trader. That commodity is held by you as stock in trade. In that case, whatever commodity transaction tax you pay to the commodity exchange, that will be allowed to you as deduction in section 36 subsection of clause number 16. That will be allowed to you as deduction in section 36 subsection 1 clause number 16. But friends, if you are holding that commodity as an investment, if you have purchased the gold as an investment, then you are holding the gold as an investment, then any profit or loss which might arise on sale of gold would be definitely taxed under that capital gain and not under that PGBP. So your commodity transaction tax should also be taken to the head of capital gain. Now the point is, in the chapter of capital gain, what is the treatment of this commodity transaction tax? The chapter of capital gain says that commodities transaction tax will not be allowed to as deduction. It will not be allowed to as deduction. The way securities transaction tax is not allowed to as deduction, similarly, commodity transaction tax will also not be allowed to as deduction if it is taken to the head of capital gains. Now that I will discuss with you in the chapter of capital gain in detail as to what will be the consequence if the deduction is not allowed. But right now I am just telling you that yes, the natural consequence of not giving a deduction for a securities transaction tax and a commodity transaction tax is there will be an increase in the amount of your capital gains. There will be increase in the amount of capital gains and you have to pay more tax. Definitely we will discuss in detail while taking a numerical example to make you understand, but that will be taken in the chapter of capital gain. So friends, for the time being we have completed section 36 subsection 1 clause 15 and we have also completed section 36 subsection 1 clause number 16. With this my section 36 subsection 1 comes to an end. Let's proceed further. Next section is section 37 subsection 1. You also know that this is over long back. Section 37 subsection 1 talks about general deduction. This is over long back. General deduction is over long back. So with this, all the sections which are allowing you deduction, if you recollect, at the beginning of the chapter, I had explained you that in this chapter we can bifurcate the section into different categories, broadly 3 categories. Number 1, section relating to income. Number 2, section relating to expenses, and number 3, other sections. Section relating to income, which are those? Section 28, charging section, and section 41, which is talking about a deemed profit. This is a section relating to income. See, section 28 is over. Section 41 is also over. But in section 41, we have discussed how many sections till now? Section 41 subsection 2 is over. Section 41 subsection 3 is over. Section 41 subsection 4 we completed today, bad debts recovered. What is section 41.2? If the power generating unit is selling the asset and if there is a profit, that profit will become taxable to them under the head PGBP. 41.3. What is 41.3? If the asset was acquired for the purpose of scientific research and the research is over and you have sold off that asset, profit is realized, that profit will become taxable to you in section 41 subsection 3. What is 41.4? This we discussed today itself, bad debts recovered. So now in section 41, we are left with only one section. In section 41, we are left with only one section. So, if I talk about the first category of section, section 28 is over. Definitely few points are left in section 28. Those will be discussed with the relevant provisions or the connected provisions. Section 41, subsection 2, subsection 3, subsection 4 is over. Now we are left with only one subsection, that is section 41 subsection 1. Section 41 subsection 1. That we'll definitely discuss in today itself. Second category of section is section relating to expenses. And you know that section relating to expenses was divided in 2 parts. It was divided in 2 parts. Sections for allowing deduction and section for disallowing deduction. Section for allowing deduction is right from section 30 to section 38. Right from section 30 to 38. In this, we have completed all the sections except one. We have completed all the sections except one. Which one we have not completed? We have not gone through section 35 AD. 35 AD was given to you as part of homework. I asked you to refer to section 35 AD. Hopefully friends, each one of you have referred to section 35 AD. So today definitely we are going to discuss this section 35 AD, but not right now. Not right now. because section 35 AD is slightly big section. If we start, then uh, it would consume around 45 minutes or 60 minutes of time. So we don't have that much time right now. Definitely, as per the schedule, I'll be giving you a break at sharp 9 o'clock and we'll have a break for 30 minutes. So I don't want to start with section 35 AD right now. So I'll be starting with some other section. But as of now, we can understand that all the sections relating to deductions allowed category are over. So we'll have a glance at the list of sections in your book. We are on page number 98. Section 30 is over, expense relating to building. Section 31, expense relating to plant, machinery, furniture. Section 32, depreciation is over. Section 32 AD, I have already told you that this section is already expired in the last year. It was valid up to 31st March 20. So right now it is not in existence. But yes, because of that one condition, I have kept that section in your notes. So this is also over. Besides section 35 scientific research also, which we discussed yesterday, section 35D, this section 35D is pending, this is yet to be discussed. Then you have section 35 CCA. See, section 35 CCA is not discussed with you and I will not discuss with you. The reason is CA Institute has removed this section from the ICI module. Up to last year, May 20, November 20 module, this section was forming part of the module. Now this year onwards, CA Institute has removed this section from the module. So it is not deleted, it is removed. Removed by ICI from the syllabus. So section 35 CCA, section 35 CCC and section 35 CCD. These three sections are not appearing in the module. So May 21 examination onwards, you are not required to refer these three sections. So section 35 CCA, CCC, CCD, they are removed from module. Those students who are appearing for the May 21 examination and for them it is not a first attempt, maybe for them it is a second attempt. In the earlier attempt they might have gone through section 35 CCA, section 35 CCC as well as section 35 CCD. But those sections are now removed, so you are relaxed. So you read less number of sections. Next is section 35D, prelim expense is over. Amortization of expenditure incurred on VRS. This is also we have discussed yesterday. Then we started with section 36 subsection 1. If you recollect, all the points in section 36 subsection 1 are over. All the points are over. Today we started with bad debts. Along with that we also discussed bad debts recovered. We completed family planning expenditure also. We also did commodities transaction tax and securities transaction tax. Section 37 subsection 1 as well as section 38, everything is over. So if you refer carefully, then you will come to know that we have completed the entire category of deductions allowed, except section 35 AD, which we are going to take up after the break. But right now, we will move on to some other section. Right now, we will move on to some other section. Which section will move on to? One second. Now, we have one more category of section. We have one more category of section for the expense, and that section is sections for disallowing the deduction. Sections for disallowing the deduction. This category we have not started. We intend to start it today. So as of now, what I am going to do is I will move on to section 40A7. Along with that, I will also move on to section 41 subsection 1. I have some handwritten notes with me. Definitely these handwritten notes I will be giving you. I will be sending you these handwritten notes in the group. So you need not copy the things. You need not copy. But before we move on to any other provision, let us move on to section 41 subsection 1. You know that when we talk about income, related to income, we are having only two sections in the Income Tax Act under that PGBP, the first one being section 28 and the second one being section 41. In section 41, we have four subsections. We have already completed subsection 2, subsection 3 and subsection 4, and now only one is left, that is section 41 subsection 1. So now friends, I move on to section 41 subsection 1. Section 41 subsection 1, I move on to, I have the journal entries passed. Here on the screen you can see that there is a handwritten notes. I have passed some journal entries to make you understand. See the chapter of PGBP, wherever it is possible, I will explain the provision by passing the journal entry, because you are very much well versed or familiar with the accounting. You are doing accounting since last 3-4 years, but tax you are learning for the first time in your life. So I would try to, wherever it is possible, I would try to pass the journal entries to make you understand the provision. Now before I move on to section 41 subsection 1, I want to just ask you, are you getting my voice very clearly? Are you getting my voice very clearly? Drop me the message and please do ask the doubts if you have any. Yes, till now I have got the doubt only from one of the students. Oh, voice is very much clear. Superb, superb. And if you have any doubts, please do drop the message without hesitating. So now we move on to section 41 subsection 1. Now we move on to section 41 subsection 1. It talks about deemed profit. It talks about what? It talks about deemed profit. So in this we are going to discuss the situation of deemed profit. So in certain situations you may have the profit and that profit might be taxed. I'll be taking up 3 cases here to make you understand the provision. I'll be taking up 3 cases. And then at the end I would summarize the cases. First of all, I would take up case 1, case 2, case 3. At the end of every case, I would summarize that particular case, and when we complete the entire provision, I would summarize the entire section for you. So listen to me very carefully. Section 41 subsection 1 is a section relating to income. It is a section relating to income. So first example, first case I am taking is, it's in case of expense. It's in case of expense. Say for example, there is previous year 1920. There is a previous year 1920. Say for example, you are dealing in LG products. For example, Manoj is dealing in LG products. He is having an electronics shop. So he is selling the electronic products pertaining to only one brand, that is LG. So LG has told Manoj that if you purchase goods worth more than 2 crores from us throughout this financial year, then we will give you 2% extra discount. We will give you 2% extra discount. So Manoj is purchasing goods throughout the year from LG. So it is purchases for Manoj. He has paid money for that. It is not a credit purchase, it is a cash purchase. So payment is made to the bank account. What entry Manoj would pass? Definitely he would pass an entry purchase account debit to bank account whenever he purchases the goods. Or if we take an example of any other expenditure other than purchases, then the moment you incur the expense, you will pass an entry expenditure account debit to bank account. So previous year 1920, you have passed an entry expense account debit to bank account. Your first entry is passed by you, expense account debit to bank account, and this expense ultimately it will be debited to profit and loss account. Ultimately this expenditure will be debited to profit and loss account. You would ask deduction. You would ask for deduction, and deduction will be allowed to you. For under which section deduction is allowed for the expense? We have different sections. But most of the expenditure is allowed to be deduction in section 37 subsection 1. If your expenditure is not covered by section 30 to 36, definitely you will get deduction in section 37 subsection 1, subject to fulfillment of certain conditions, saying that expense should be related to your business, it should be a revenue expenditure, it should not be a capital expenditure, it should be a legal expenditure, should not be a illegal expenditure, etc. All those conditions are fulfilled, then you can claim deduction for the expense in section 37 subsection 1. Now let me tell you that previous year 1920, Manoj has passed an entry in his books of accounts, either purchase account debit to bank account or expense account debit to bank account. What is the consequence? Deduction will be allowed to him. Deduction will be allowed to him for this expense. So this entry is passed in the past year and deduction is allowed to him. Now comes the next year, that is previous year 2021. Previous year 2021, LG people are referring to the records and they found out that Manoj has purchased goods worth more than 2 crores. Manoj has purchased goods worth more than 2 crores in the last year. They are not talking about, right now we are in which year? Previous year 2021. LG people promised Manoj that if you purchase goods worth more than 2 crores, we'll give you extra 2% discount. That promise was for which year? For the financial year 1920. So financial year 1920, he has purchased goods worth more than 2 crores. Now LG people are going through the records in the financial year 2021 and they conclude that yes, Manoj has purchased goods worth more than 2 crores. So he is entitled to 2% extra discount. So say for example, Manoj has purchased goods worth more than 2 crores. Let me give you the amount. He has purchased goods worth say 3 crores. So has he purchased goods worth more than 2 crores? Answer is yes. So LG people, they are going to give a discount to him. How they would give him the discount? Manoj has already paid the amount of 3 crores over the period of entire year. So in that case, LG people will make a check of 2% amount of the sales. So goods worth 3 crores were purchased by Manoj. So LG people, they are going to give a discount of 2% extra. 2% of 3 crores is nothing but 6 lakhs. So LG people, they will make a check of 6 lakhs and they will send it to Manoj. This check is received by Manoj in which year? 2021. Definitely he would pass some entry in his books of accounts. What entry he would pass? He would pass an entry bank account debit to discount received. Bank account debit to discount received, or he may pass an entry bank account debit to commission received. Whatever entry he will pass, ultimately his profit and loss account is going to get credited. So entry might be bank account debit to discount received or bank account debit to commission received, and then the second entry would be discount received account debit, commission account debit to profit and loss account. Now on the credit side of profit and loss account, this entry is appearing of 6 lakhs. Question is, should that be taxed or should it not be taxed? Should that be taxed? That is the question. So answer is yes, it should be taxed. It should be taxed. It will be taxed, but under which section? It will be taxed in section 41, subsection 1. It will be taxed in 41, subsection 1. So what section 41, subsection 1 says? It says, if the deduction was allowed to you for any expense in the past year. See, deduction was allowed to you for the expense. When the deduction was allowed to you for the expense, it was allowed to you in the past year. Means in our example, previous year 1920. Now against that expense, sum of money is received. Sum of money is received. Against that expenditure, against the deduction which was allowed to in the past year, in the current year, sum of money is received. What will become in that case? That amount received will become taxable. That amount received will become taxable. So here once again it goes beyond, or it goes against the basic taxability criteria of the chapter of PGBP. You know that PGBP income is taxable based on the method of accounting followed by the SSE. But here in section 41 subsection 1 we are saying that if expenditure was allowed to as deduction in the past year, and against that expenditure, if you are receiving some amount of money in the current year, that money received will become taxable to you. In other words, taxability is on receipt basis. Taxability is on receipt basis. So this conclusion is what? If the deduction was allowed for the expense in the past year against which sum of money is received in the current year, amount received will be considered as deemed profit and it will be taxable under section 41 subsection 1. It will be taxable in section 41 subsection 1. Friends, with this case number 1 is over and case number 1 was talking about an expenditure. So what is the one line conclusion? If the deduction was allowed for the expenditure in the past year and the current year, if you receive some amount of money against that expenditure, then the amount received will become taxable to you in the year of receipt as per section 41 subsection 1. Friends, case number 1 is over. Now before I move on to case number 2, do you have any doubt in case number 1? Case 1, do you have any doubt? Yes? If it is clear, no doubts, very good, superb. So case number 1 is clear. Let's move on to case number 2. Case number 1 is very much clear. So we move on to case number 2. Case number 1 was talking about an expenditure. Case number 1 was talking about an expenditure, whereas case number 2 is talking about a loss. Definitely there is a difference between an expenditure and a loss. Case number 1 was focusing on expense, whereas case number 2 is focusing on loss. So let us take an example of loss to make you understand case number 2. Say for example, a fire has taken place in your business premises, in your factory, or maybe in your godown, fire has taken place. In your godown, fire has taken place, so a lot of stock might have burnt by fire. So you might have incurred loss by fire. If the goods are burned, you might have incurred a loss by fire. What journal entry you would pass in your books of accounts? Loss by fire account debit to goods lost by fire account. If the fire incident has taken place in your warehouse or godown and the stock is burned, then there is a loss to you. You are lost goods by fire, so you will pass an entry, loss by fire account debit to goods lost by fire account. This loss by fire account will be transferred to debit side of profit and loss account, and goods lost by fire account will go on to credit side of trading account. Now the question is, you have incurred a loss. Can you claim deduction for this loss? Can you claim deduction for this loss? If yes, under which section you can claim deduction? Some of you might think that deduction should be allowed in section 37 subsection 1, but your thinking is totally incorrect. Why now? Because section 37 subsection 1 does not give you deduction for the loss, it gives you deduction only for the expense. It gives you deduction only for the expense. So in which section you can claim deduction for the loss? Do you have any specific section saying that if you have incurred the loss because of fire, then we will give you deduction? We don't have a specific section. So where you will go? So definitely you will go to section 28. If you recollect, section 28 clause number 1 says, profits and gains of any business or profession carried on by the associate during the previous year. And how do you ascertain these profits and gains? It is nothing but revenue incomes and gains minus revenue expenses and losses. So if the fire has taken place, your goods have burned by fire, there is a loss, and this is a revenue loss. This is a revenue loss. This is a business loss. This is not the probable or estimated loss, it is the actual loss. So this will be definitely allowed to as deduction. Where? In section 28 clause 1, deduction will be allowed. Deduction will be allowed in section 28 clause 1. Now say for example, this is the story of previous year 1920. This is the story of previous year 1920. While computing income of the previous year 1920, you have claimed deduction for this loss. Now comes the next previous year, and that is previous year 2021. Previous year 2021. What has happened in previous year 2021? You had taken the insurance for your godown. You had taken the insurance for your stock also. So you have intimated to the insurance company that in the month of March fire has taken place in our premises. and lot of goods have burned by fire, so there is a loss by fire. So insurance company, the moment you inform them that this incident has taken place, they would send their officer to your premises. They would send their officer to your premises to inspect the area in which the fire has taken place. So he'll do the inspection. He'll make a judgment as to how much goods are burned by fire. He may ask you some accounting records, and he may inspect the premises. Based on that, he'll make a judgment as to how much goods are burned by fire, how much loss you have incurred, and then he'll submit a report to the insurance company. And based on that report, insurance company would grant you a compensation. Now, say for example, insurance company is granting you a compensation in the previous year 2021. If you have received the compensation from the insurance company in the previous year 2021, what journal entry you are going to pass? Definitely, you are receiving compensation, so you are receiving money. Bank account is going to get debited. So you will pass an entry, bank account debit to insurance claim received account. In the previous year 2021, you will pass an entry, bank account debit to insurance claim received account, and then you will pass an entry, insurance claim received account debit to profit and loss account. So the ultimate entry is bank account debit to profit and loss account. Ultimate entry is bank account debit to profit and loss account. So on the credit side of profit and loss account, it will appear insurance claim received. So the question is, will that become taxable? Question is, will that become taxable? Answer is yes, it will become taxable. Because of which section? Because of section 41 subsection 1, case number 2. So we say that bank account debit to insurance claim received, this is credited to profit and loss account in the current year. Will it become taxable? Yes, it will become taxable. So what is the conclusion of the second case? If deduction was allowed for any loss, deduction was allowed for any loss in the past year against which sum of money is received, sum of money is received, in that case amount received will become taxable. Amount received will become taxable as per section 41 subsection 1. So in this also tax is levied based on receipt. Income is taxable based on receipt basis. So what is the difference between the first case and the second case? First case is talking about an expense, whereas second case is talking about a loss. What is common point is, in first case, in the past year you have claimed deduction for the expense, whereas in the second case, in the past year you have claimed deduction for the loss. And in the current year you are receiving sum of money, so there is an inflow of money. That money received will become taxable to you in section 41 subsection 1. With this, case number 2 is also over. Case number 2 is also over. Now friends, we need to move on to the last case, that is case number 3. Once we complete this case 3, our section 41 subsection 1 would come to an end. Now before I move on to case 3, I want to ask you the same question once again, whether the case 2 is clear to you. Yes, case 2 is very much clear. Yes. So I have received messages from a lot of people. Yes, I have received 3, 4, 5, 6 messages saying that yes, case 2 is clear. So now friends, let's move on to case 3. Let's move on to case 3. Case 3 is talking about a trading liability. Case 3 is talking about a trading liability. See, in income tax we use the word trading liability, but in accounts you are using the word trade creditors. What word you are using in the accounts is trade creditors. When we talk about trade creditor, we are talking about a credit transaction of purchase of goods. We are talking about a credit transaction for purchase of goods. Now say for example, it is previous year 1920. Previous year 1920, I have purchased some goods on credit basis from Manoj. So what entry I will pass in my books of accounts? Purchase account debit to Manoj's account. Manoj is my creditor. I have passed entry purchase account debit to Manoj account. My previous year 1920 has come to an end. See, ultimately creditors would appear on the liability side of balance sheet. And where my purchase will go? Purchase will go to the debit side of trading account. So if it goes to the debit side of trading account, it is an expenditure. It is an expenditure. Can I claim deduction for that? Yes. But I have not paid money. I have purchased goods, but I have not paid money. So instead of expenditure, we call this as trading liability, because money is yet to be paid for purchase of these goods. So this is called as trading liability. Dikshit says that my screen has got stuck. What about others? Others can see the screen very clearly. Yes, screen is visible to you. Yes, screen is visible. So Dikshit, what you can do is you can log out and once again log in. There is some problem from your side because other people are in a position to view the screen very clearly. So you can log out and once again re-log in. So you will not have any problem. So friends, let's move on to third case. Third case, we are saying that you have passed an entry purchase account debit to creditors account. This purchase goes to the debit side of trading account, and while computing the business income, you have claimed deduction for that purchases. But since you have not paid money, we call this as trading liability, and we say that you are being allowed deduction for the trading liability. You are being allowed deduction for the trading liability. Under which section deduction will be allowed? Definitely section 37 subsection 1. See, if you purchase the goods and you pay money, then it is an expenditure. It is no more a liability, it is just an expenditure. But if you purchase the goods on credit basis and you have not paid money, then definitely it is an expenditure as well as a trading liability. So we are focusing on a credit transaction. We are focusing on a credit transaction. You have passed the entry purchase account debit to creditors account, and you have debited the profit and loss account, trading account by the purchases. Deduction is allowed to you. Deduction is allowed to you. Then after, what has happened? I purchased these goods from Manoj. Now say for example, Manoj is not married, so he is not having wife and kids. Manoj is alone. He is alone, he is doing business, and he met with an accident in the previous year 2021. Manoj met with an accident in the previous year 2021. So Manoj has left this world. Now I was supposed to pay Manoj 5 lakh rupees for purchase of goods on credit basis. I had purchased goods from Manoj on credit basis in the previous year 1920. That 5 lakh was yet to be paid. It was forming part of my creditors. But since now Manoj has expired, who is going to recover that money from me? No one. Because he doesn't have wife and kids. No one is going to take over his business. So his business will shut down. So whatever goods I purchased on credit basis for 5 lakh rupees, that creditor is appearing in my books of accounts. But it is no more payable to Manoj because Manoj did not exist. Manoj do not exist. My liability also do not exist. So my liability ceased to exist. My liability ceased to exist. Don't you feel if my liability ceased to exist, it is a gain for me? Definitely yes, it is a gain. If your debt has become bad, you write it off, it is a loss for you. But if you are not required to make payment to your creditor, you write off your creditor, it is not a loss for you, it is a gain for you. So in the next year, that is previous year 2021, I have written off my creditors. What entry I would pass? Creditors account debit to creditors return of account. And this creditors return of account, ultimately it will be reflected in the credit side of my profit and loss account. So on the credit side of profit and loss account, what it is appearing? Creditors return off. Will that become taxable? Answer is yes, it will become taxable. But here I am not receiving money. There is no inflow of funds. In the first and the second case, there was inflow of funds. I had received money. In the third case, I am not receiving money, but my liability ceased to exist. See, in English, there is one idiom. We say that money saved is money earned. If you save something, that is as good as earning only. So here, I am not required to make payment to my creditor. So I have saved something, that amount saved, that is as good as income. So will it become taxable to you? Yes, it will become taxable. Yes, it will become taxable. In which year? Year in which my liability ceased to exist. Year in which my liability ceased to exist. In that year, it will become taxable to me. I have received one doubt from Shruti. I will take up the doubt once I complete this explanation. So, I have passed an entry creditors account debit to creditors return of account and then creditors return of account debit to P&L account. Will it become taxable? Yes, it will become taxable. In which year? The year in which you write off the creditor. In that year, you are not receiving money, but your liability ceased to exist. So, there is a benefit received by you. This benefit received will become taxable. So, what it says? If the deduction was allowed for a trading liability, deduction was allowed for what? Trading liability in past years, and subsequently there is a cessation of trading liability, then the benefit accrued will become taxable to you under section 41 subsection 1. Benefit accrued will become taxable to you under section 41 subsection 1. Shruti is asking me, sir, can you give an example of a situation wherein my liability ceased to exist because of any reason other than death? Because of any reason other than death. See, mostly there won't be any reason, any other reason other than death for a liability ceasing to exist. Liability can generally cease to exist only when my creditor cease to exist. Or maybe my creditor has forgotten that he is supposed to receive some amount from me. This is not going to happen. So practically my liability would generally cease to exist only when my creditor cease to exist. So if the creditor dies and there is no one who is his legal heir, in that case there is my benefit. My liability cease to exist. So I could not get any other example. This is the only example. But in this I have one more point to be covered in this third case. Say for example, I have purchased goods from Manoj on credit basis worth 1 lakh rupees. So this is my trading liability. These goods are purchased on credit basis from Manoj in the past year. So past year I might have passed an entry purchase account debit to creditor account, and this purchase would have been debited to my profit and loss account, and definitely I would have claimed deduction for this. Now in the current year I am required to make payment of 1 lakh to Manoj. So instead of 1 lakh I am sending a check of say 98,000. Instead of 1 lakh, I have sent a check of 98,000 to Manoj. The moment he saw a check of 98,000, Manoj called me up saying that, sir, you purchased goods worth 1 lakh from me and you send a check of 98,000. So when you are going to send a check of 2,000, why did you send the check of 98,000? You should have sent the check of 1 lakh only. I told, no, Manoj, intentionally I have sent you the check of 98,000. 2,000 I have taken discount. 2,000 I have taken discount. Manoj says, sir, no discount. Already I have sold you goods at a very cheaper price, very reasonable price. Don't expect discount from me. I said, no, Manoj, with whomever I deal, I take 2% discount. If you don't want to give me discount, then we will not deal in future. So our business transaction, business relation will come to an end. Minimum 2% discount is required. So Manoj was not agreeing to it. Still, I passed an entry in my books of account for this 2% discount. So what entry I passed now? Creditors account debit 1 lakh, to bank account 98,000 and to creditors return of 2,000. So this 2,000 I am not going to pay to Manoj. This is my decision. So this is a unilateral act. It is a one-sided act. If I ask for the discount and Manoj willingly says, yes, okay sir, okay, not an issue, you take 2% discount. In that case, it is a bilateral act. Bilateral means both the parties to the transaction are consenting to it. So, income tax says, irrespective of whether it is bilateral act or unilateral act, the moment you write off the creditor, it appears on the credit side of your profit and loss account, you have derived the benefit and will become taxable to you in section 41 subsection 1, irrespective of whether such write-off is unilateral or bilateral. Is that very, very clear to you? Yes? If you want to find out the difference, what is the difference between case 1, case 2 and case 3? Case 1 is talking about an expense, case 2 is talking about an loss, case 3 is talking about a trading liability. If I want to find out the difference between case 1, 2 versus case 3, then case 1 and 2, case 1 and 2, in the subsequent year, you have received some amount of money. Whereas in case 3, you are not receiving money. There is no flow of money. There is no inflow of money. In case 3, you are not required to pay the liability anymore. So it is a gain for you. It is a gain for you, but there is no inflow of money. So now before we actually conclude this, we have two more important points. But before we move on to those important points and conclude this section, let me tell you the entire section, all the three cases in one sentence. Section 41 subsection 1 says, if you have claimed deduction for any expenditure or loss or a trading liability in the past year and the current year, there is some amount of money against that, some amount of money received against that expenditure or against that loss, or there is a remission or cessation of trading liability. There is a remission or cessation of trading liability, then that amount will become taxable to you in the year in which money is received or in the year in which there is a remission or cessation of a liability. Is that very clear? So, if there is a remission or cessation of trading liability, it will become taxable irrespective of whether it is a unilateral act or bilateral act. No. Devadarshini, it is not taxable only in case of unilateral act. It is taxable even in case of bilateral act. Bilateral act means I am asking for discount and Manoj is willingly giving me discount. In that case, it is a bilateral act. Government says we don't make any distinction between a unilateral act and bilateral act. It will become taxable in both the cases. It will become taxable in both the cases. Have you all understood very clearly? Yes. Shall I proceed? Now let me conclude section 41 subsection 1 just by referring to the two important points. Two important points to be dealt with. Number one important point, taxability under section 41 subsection 1 arises even if business or profession is discontinued. So very important point, similar to section 41 subsection 4 bad debts recovered, even if the business is discontinued, this 41 points will become taxable to you. This is the first important point, and now let's move on to the second important point. Taxability under section 41(1) arises even in the hands of successor if the deduction was allowed to the predecessor. So if I die and my business is taken over by my child, and in that case some amount of money is received by him against an expenditure or a loss, or there is a remission or cessation of trading liability and he is passing the entry in books of accounts, SSE has changed but business has remained the same. So taxability arises in 41(1) even in the hands of successor if the deduction was allowed to predecessor. Is that very clear? Have you understood these two important points? Yes, drop in the message. Yes. So we have completed section 41 subsection 1. We have completed section 41 subsection 1. So before the break we have completed section 41 subsection 1. We completed section 41 subsection 1. So with that our sections relating to incomes are over. Besides that, sections relating to expenses in that the first category, sections relating to allowing the deduction for expenses over, except one section, that is section 35 AD, that is what we are proceeding with. So we move on to one of the big section in the chapter of PGBP, and that is section 35 AD. I am sure you might have referred it once. Now before we actually move on to section 35 AD, we are on page number 123 in your notes. Before I move on to section 35AD, if I want to ask you a very simple question, what is the benefit section 35AD is offering to the taxpayer? What is the benefit granted by section 35AD? Yes, what is the biggest advantage of section 35AD? It gives you deduction for capital expenditure. It gives you deduction for capital expenditure. See, generally whatever capital expenditure you incur is capitalized and depreciation deduction is claimed on it. But we have certain sections in the chapter of PGBP wherein you get the deduction for the entire cost of an asset. One of the section we discussed yesterday, and that was section 35 relating to scientific research, And the other one is section 35AD related to specified business. Here in section 35AD, we have the list of 14 businesses, 1-4. We have the list of 14 businesses. In this business, there are very less people or there are very less companies into these businesses, and wherever, kindly switch on the webcam. You can't see me? Okay, students can switch on the webcam. Are you all getting my voice very clearly? Okay. Now, I was telling you that in the chapter of PGBP in income tax, we have two sections which gives you deduction with respect to capital expenditure at one go. And those are section 35 as well as section 35AD. Section 35 I discussed with you yesterday. It was in connection with scientific research. Now today we are going to discuss section 35AD, which is in connection with certain businesses. And there are 14 businesses covered here. So government feels that there are less number of industrialists or less number of people into these businesses, or government wants more people to get into these businesses so that whenever there are more people into the businesses, there will be more competition. If there is more competition, then definitely the final customer, final consumer would get the advantage of this. So either the products or the services are costly, so government wants that more number of people or more number of industrialists to get into these businesses, or there is no facility at all. Therefore, government says you set up such kind of facilities, then we will give you deduction. I had already sent you 5-6 different videos to watch, and all those videos were in connection with section 35AD. So as and when we progress, as and when we move on to this section 35AD, as and when we move on to different points, you will realize the importance and you will be in a position to connect those videos with the content of the section. But before we move on to section 35AD, let me tell you that in section 35AD there is a budget 20 amendment. What is that amendment? That amendment says that it is not mandatory for the assessee to claim deduction in section 35AD. He has an option. So he has to opt whether he wants to go for section 35AD or not. See, I'll explain you. There are two types of sections. Number one is investment. Two types of sections for giving you deduction. For giving you tax benefit, or maybe we can say for giving you tax benefit, there are two types of sections. One is based on the amount which you invest in the business. The first one is based on the amount which you invest in the business. So it is investment linked deduction. Investment linked deduction. So you have to just invest money. You have to just invest. based on the amount invested, your deduction will be computed. Based on the investment, deduction will be allowed. So these deductions are called as investment linked deduction. Section 35 AD gets into this category of investment linked deduction. And the second category is income based deduction. Second category is income based deduction. Here you need to start a business. In this case, you need to start business. So basically we are expecting you to do investment. So here you need to do investment. Once you have done the investment, you will start business. Once you have started the business, you will earn profits. And deduction is allowed for the amount of profits which you have earned. So deduction is allowed and it is calculated for profits of business. Basically, whatever amount you have invested, for that deduction is not given. You have invested money, you have done the business, you earned the profit. For that profit, deduction will be allowed. For example, we have section 10AA. We have not discussed it. We will discuss when we move on to the chapter of income exempt from tax. We have a section called as section 10AA, which says that if you set up an manufacturing unit, etc., in a special economic zone, then whatever profit you earn for 15 years, we will not levy any tax. So you will be enjoying a 15 years tax holiday. You will be enjoying a 15 years tax holiday. Now the point here is whether SSE should go for investment linked deduction or he should go for income based deduction. That he has to decide at the initial stage itself. So he has to decide whether he wants to claim deduction for the amount he has invested. In that case, he can't go for income based deduction. He has to decide one of the path. If he decides to move on to first path, then whatever amount he has invested, he can claim deduction. If he decides to go on to the second path, then whatever money he has invested, now he can't claim deduction. He has to do business, he has to earn profits, and whatever profits he have earned out of the business, that profits will not be taxable. That profits will be allowed to be deducted from the income. So SSE has to claim either income based deduction or he has to claim investment based deduction. He cannot claim both. He cannot claim both. Government says we are not going to give you dual benefit to you. We are not going to give you dual benefit. Double benefit will not be given. So you have to decide at the initial stage itself as to whether you want to go for investment based deduction or whether you want to claim income linked deduction. Accordingly, Budget 2020, Section 35 AD is amended to say that it is the option available to the SSE. He has to decide whether he wants to go for Section 35 AD or not. It is not mandatory for him to go for Section 35 AD. If he feels that no, if I go for income based deduction, I will be getting more benefit, then let him go for income based deduction. So here Section 35 AD says an SSE shall, if he opts, SSE shall definitely get deduction provided he opts. He has to opt. He has to exercise the option saying that yes, I want deduction under Section 35 AD, which is calculated based on the amount invested. If he goes for this, definitely he cannot go for income based deduction. So we'll try to understand that which are those 14 businesses for which you can claim investment based deduction. Biggest advantage of this Section 35 AD is SSE can claim deduction for the capital expenditure. He can claim deduction for any capital expenditure except three. He can claim deduction for any capital expenditure except investment made in goodwill, investment made in land because it is a non-depreciable asset, and investment made in a financial instrument. Financial instrument means you have acquired the shares, etc. So, any investment made or any capital expenditure incurred for what? For acquiring goodwill, for acquiring land, or for acquiring any financial instrument, that cannot be claimed as deduction under section 35 AD. In other words, you can claim deduction for investment made in plant, machinery, furniture, building, etc. So, you can claim deduction for a capital expenditure other than investment in goodwill, other than investment in land, and other than investment in financial instruments. Now friends, one by one I will move on to the points. There are 14 there is a list of business, there are 14 points. One by one we will refer to that, and we will try to understand why government has inserted such point in the Income Tax Act in section 35D, why government is giving so much amount of reduction to this business. First point, against every point there is a date. So for example, here the date is 1st April 2009. So that particular business should commence on or after that particular date. If the date is say 1st April 2009, meaning thereby this point is come into this section 35D in budget 2009. This point might have been inserted in section 35D in budget 2009. Therefore, it is applicable with effect from 1st April 2009. What it says, point number 1 says, setting up and operating a cold chain facility. See, there are a lot of perishable commodities, right? Fruits, vegetables, etc. One of the survey conducted by the government of India says that vegetables and fruits, before it reaches the market, at around 30 to 35% vegetables and fruits get perished only. So it doesn't reach the market. 100 kg of produce now, out of 100 kg of produce, only 65 kg reaches to the market, 35 kg it gets perished before it reaches the final consumer. Why this is happening? Because we don't have the adequate cold chain facility in the country. If you have the cold chain facility is nothing but a refrigeration system. In our households, we have a refrigerator, very small in size, but when it comes to storing vegetable, fruits, etc. on a very large scale, we have very big warehouses. Those warehouses would be refrigerated warehouses, so that perishable commodity can be stored easily, it will not perish. So government says you set up a cold chain facility, for that you incur capital expenditure, that entire capital expenditure will be allowed to as deduction. What is the objective or the purpose behind it? So that the vegetables, fruits, etc. can be stored for a longer span of time, and if it is more in supply, if it doesn't get perished, more quantity will reach to the market and the prices would be reasonable, prices would not fluctuate. We can store in a cold chain facility and throughout the year we can supply in the market. Now cold chain facility, they have given the meaning. I have just said that vegetable and fruits can be stored, but they have given the meaning. Besides vegetable and fruits also you can store a lot of things. So cold chain facility means chain of facilities for storage or transportation of agricultural produce. Agricultural produce means food grains, etc. or forest produce. Agriculture produce or forest produce, or meat products. Meat also it is required to be stored. Poultry or marine products. Marine product means fish, etc. Seafood. Dairy products. Products of horticulture, floriculture means flowers. Agriculture and processed food items under scientifically controlled conditions, including refrigeration and other facilities for preservation of such products. So with the intention to ensure that all these commodities are preserved and it doesn't get perished, so that more quantity reaches to the market, there will be more supply, prices would be reasonable enough. So government has come out with this point saying that if you set up a cold chain facility, whatever capital expenditure you incur, that will be allowed to you as deduction. This is point number 1. Point number 2 is also talking about a warehousing facility only, but the first one was a cold storage warehouse. The second one, point number 2, is a normal warehouse for storing agriculture produce. See, storage of wheat, rice, etc., or storage of pulses, etc., it doesn't require a cold storage. It doesn't require a cold storage. For example, onion, potato, onion can be stored in a normal warehouse also. Cold storage system is not required. So if you set up a warehousing facility for storage of agriculture produce, then you can claim deduction in section 35 AD. In the videos which I had sent you, if you have referred all those videos, in that we had 2-3 videos wherein you might have observed that in India we don't have the adequate amount of storage facility. Therefore, the food grains are stored in an open space. If the food grains are stored in an open space near the railway tracks, then it may catch a moisture. It may catch a moisture. Quality may get deteriorated, and then it will be not useful for human consumption. That is the reason government has come out with an amendment saying that if you set up a warehousing facility for storage of agriculture produce, then whatever capital expenditure you incur for creating those warehousing facilities will be allowed to you as deduction. Third point is laying and operating a cross-country natural gas, crude or petroleum pipeline network for number 1 distribution and number 2 storage. Let me give an example. Say for example, if you are getting that LPG cylinders, cooking gas, if the cooking gas is supplied to you in the cylinders, then a lot of cost is involved. For example, in your house, the cylinder has got empty. So what you will do? You will call up the cooking gas supplying company. You will place an order saying that please deliver me the cylinder. So that one person will come to your house. He will pick up the empty cylinder. He will pick up the empty cylinder and he will deliver you the filled up cylinder. So he'll pick up the cylinder. He'll put that cylinder in his small vehicle, maybe 3-wheeler, etc. He'll put the cylinder, and then that 3-wheeler will reach the warehouse of a distributor. Once again that cylinder will be picked up. So the distributor would be incurring loading charges, unloading charges. And from the distributor's place, the gas company will come. They will pick up the empty cylinders and they will take the empty cylinders to factory premises for filling the gas. So here also transportation cost is involved. And all the vehicles would run either on petrol or on diesel. In India, we don't have petrol, diesel, we are importing. So the price of petrol, diesel, they are not within the control of the government. They have to accept whatever price is there in the international market. If the price of the petrol or diesel increases in the international market, then the transportation cost will increase. If the transportation cost increases, then definitely the price of the cooking gas cylinder is required to be increased. And if the price of cooking gas cylinder is increasing, then people will not be in a position to afford it. It will be costly for them. Therefore, government is having an intention that throughout the country, wherever possible, cooking gas should be supplied through pipelines. And you might have observed that wherever the cooking gas is supplied through pipeline, the cost is less because there will not be any loading charges, no unloading charges, no transportation charges. Because of not incurring this cost when the cooking gas is supplied through pipeline, there is no loading charges, unloading charges, or there is no storage charges also, because distributor will not store the tank empty cylinders, etc. So number 1, there is no loading charges. Number 2, there is no unloading charges. Number 3, no storage charges. And number 4, no transportation cost. But definitely it would require huge amount of investment at the initial stage, saying that in every area you have to set up a pipeline. So setting up that pipeline is a one-time cost. Thereafter you need not incur any other cost. So a lot of recurring costs are avoided. Thereby the price of the cooking gas will be lower and cooking gas can reach to the customer at a reasonable price. With the intention to ensure that, government has come out with point number 3 in section 35 AD, saying that if you are laying and operating a cross-country natural gas, crude or petroleum pipeline, whatever capital expenditure you have incurred, that capital expenditure will be allowed to as deduction. So with this, we have completed point number 3. Now we move on to point number 4. Point number 4. Point number 4 says building and operating anywhere in India a hotel of 2-star or above category as classified by the central government. Building and operating anywhere in India a hotel of 2-star and above category as classified by the central government. Kritika is asking me how much deduction is allowed. Don't worry about that. We are going to discuss everything. Right now we are just referring to those, the list of businesses in which deduction is allowed. How much deduction is allowed? What is the manner of claiming deduction? Everything will be discussed in detail with you. Don't worry about that. Once we complete the discussion, thereafter, if at all you are having the doubts, please do ask. Right now, let me first of all complete the list of 14 businesses, and then in the second part, we'll want to understand how much deduction is allowed. Are there any conditions which are required to be fulfilled for claiming deduction? All those things we'll discuss in detail, definitely. So we are right now just referring to the list of businesses. We are in point number 4. Here they are saying that if you build a 2-star or above category hotel as classified by the central government, then you can claim deduction. Say a country not having warehousing facility for storage of food grains, etc. Why such country is giving incentive for setting up 2-star hotels? Because see, the biggest business in the world is a tourism business. The country which can improve or maintain its tourist places can have huge amount of business with lowest amount of investment. India can become the tourist destination for the entire world. Spiritual tourism is highest in India. We will find that there are a lot of temples, lot of mosques, etc. which people would like to visit. So India can become one of the best destinations when it comes to tourism, because there are a lot of places to see in India, but Indian government unfortunately over a period of time has not given any importance to tourism. See, in India we have a lot of tourist destination, but when you go to that tourist place, you will not find a good quality hotel. There are very small hotels, and if you stay in that hotel, you also will not have the geyser facility in the bathroom. So if you want a hot water for taking a bath, then you will have to pay 10 rupees, and on that stove he will make a hot water and give it to you. 10 rupees he will charge for one bucket. See, this kind of basic facility should be there. So people who are coming to visit the tourist places from abroad, they would need certain basic necessities, basic facilities. Therefore, government says there are a lot of tourist destinations in this country to visit, but everywhere, most of the places, you don't have the proper hotels to stay. So, government says you set up a 2-star and above category hotel, then whatever capital expenditure you have incurred, we are going to give you deduction for that. This point came in section 35D in budget 2010. So, it is applicable with effect from 1st April 2010. In other words, if you are already into this business prior to the introduction of this section or prior to inserting that particular point in the section, then you are not eligible to claim any deduction in section 35D. For example, here in point number 4, they are saying that you should commence the business on or after 1st April 2010, and you have already commenced the business in 2005. You are into a hotel business, you already commenced the business prior to 1st April 2010. In that case, you are not eligible to claim any deduction in section 35D. You will be eligible to claim deduction only if you commence the business on or after the date which is given in the Act. Have you understood this? Point number 4 we have completed. So, you set up a 2-star and above category hotel. then whatever capital expenditure you have incurred will be allowed to you as deduction. Now here we need to understand one important point which is given here in the form of a note. What it is, in one of the case, a foreign company came to India, that foreign company, first of all, they set up the hotel. They set up the hotel chain system, means multiple hotels they set up in different parts of the country. They set up the hotel and the day-to-day operations like making the food for those people who are residing in the hotel, kitchen. That foreign company did not operate the kitchen or housekeeping, etc. Those things were outsourced. So the hotelier outsourced the food making, entire kitchen activities, and it also outsourced the housekeeping activities. So operations of hotel were outsourced. Operations of the hotel were day-to-day operations of the hotel were outsourced. So in one of the situation, the foreign company had come to India and it has set up lot of hotels, multiple hotels in multiple cities, but the operations, day-to-day operations were outsourced. Income tax officer denied deduction to that foreign company, saying that the provision says you have to build an hotel and you have to operate. Between build and operate, we have written the word and. Means SSE has to build and only he has to operate. He cannot outsource the day-to-day activities. Based on this language, income tax officer denied the deduction to the SSE. That foreign company wrote a letter to the government of India saying that your officer is a useless person. He is showing me that word and here, he is showing me grammar. I have invested crores of rupees on the promise from your side that I will be eligible to claim a deduction. Therefore, government came out with an amendment in point number 4, and government says if you just set up an hotel and the day-to-day activities are outsourced, in that case also you are eligible to claim deduction under section 35 AD. So point number 4 note says where an SSE builds a hotel of 2-star and above category as classified by the central government, and subsequently while continuing to own the hotel, he transfers the operations thereof to another person. So day-to-day operations of the hotel are outsourced. The SSE shall be deemed to be carrying on the specified business and shall be consequently entitled for deduction under section 35 AD. So even if you outsource the day-to-day activities, day-to-day operations, still you will be eligible to claim deduction under section 35 AD. Hopefully friends, this point number 4 is very much clear to you. Point number 5, there cannot be the right time to explain the importance of this point other than this time which we are going through it, that is COVID-19 times. Point number 5 says building and operating anywhere in India a hotel with a hospital with at least 100 beds. So in India, if you go to any hospital, we have very small hospitals with 10 beds, 15 beds, 20 beds, etc. Even if a doctor is having a space of say 600 square feet, in that a 600 square feet small space, he will set up an entire hospital. See, why the hospital facilities is costly in India? Na? Because it is not enjoying the benefit of economies of large scale. If I set up a hospital with say 1000 beds, with 2000 beds, 50 operation theaters, can you imagine what would be the scalability of that hospital? More it is scalable, you can get the economies of large scale and the patients would get the same facility at a very low cost. That is the reason government has come out with an amendment saying that you set up a hospital. Which kind of hospital? With at least 100 beds. It should have at least 100 beds. So government intends to ensure that big giant hospital with more number of beds should get set up in India, so that these hospitals would enjoy the economies of large scale. Lot of things would be available to them at a lower price. facilities can be provided to the patients at a very low price or at a some reasonable price. Therefore, government has come out with that. So, over a period, see, this point was introduced in Income Tax Act in Section 35D long back in 2010. Now, looking at the situation as of now, you might definitely conclude that even though there is a section, very less number of people might have taken the benefit of this section. That is the reason we are facing scarcity of hospital beds right now. So, this just by making a section, you cannot say that yes, all these facilities will be developed in the country. The business people should also have the confidence on the government. A lot of other things are also required. Government should also ensure that all the legal formalities like taking the license, etc., all these are taking place at a very faster pace. So there should be ease of doing business in the country. In India, due to corruption or other reasons, even if you want to take a small license, you have to pay money to the government officer. All these things would take place. So anyway, let us not get into that. But I am telling you that if you set up an hospital with 100 beds or above, government says whatever capital expenditure you incur, we will give you deduction for that. So point number 5 is over. Next is point number 6. Developing and building a housing project under slum rehabilitation or redevelopment scheme framed by the government. See, there is no city in the country. In India, we don't have any city without slums. Every city you will find that there is a slum. See, it is not that if the premises are in a chawl system, it is not good. The point is, there should be adequate amount of space between the premises, saying that if something happens, say for example, if fire takes place, then the fire brigade vehicle should be in a position to get into that space. So there should be adequate. Oh, Zoom, you tell me now. Okay. So, one second. Huh? So, the houses should be such that between two buildings there should be adequate space so that a fire brigade vehicle can run through it. If some untoward incident happens, then we can have a control over it. But in the slums, you see that there is no space for a human being to walk, where there will be a space for the vehicles to move through it. Therefore, government has come out with a section in 2010 saying that if some builder is taking up a slum rehabilitation program and he is demolishing all these small houses and huts and he constructs a building over there, and the accommodation is given free of cost to those who were residing there, and the remaining part he will sell it and earn the profit. So, if any builder is taking up a very big housing project as per the guidelines set up by the government of India, in that case, whatever capital expenditure is incurring, that capital expenditure will be allowed to him as deduction. So point number 6 is over. We move on to the next point, that is point number 7. Point number 7. Developing and building a housing project. Once again, point number 7 is also talking about a housing project, but it is slightly different as compared to point number 6. See, housing is very costly in metros. Specifically, I would like to say that in Chennai, the price of property is comparatively less, as compared to other parts or other cities like say Mumbai or maybe Delhi. Mumbai, Delhi, etc. Prices of property is like anything, unimaginary prices. You might have gone through the news recently in the last month only. The owner of D-Mart, he purchased a property for 1,000 crore. And the per square feet rate was, I don't remember the amount, it was around 1,60,000 rupees per square feet. At that rate he bought the property. And the property price was more than 1,000 crore. So, in India, people are not in a position to afford the house. because the prices are skyrocketing. So government came out with an amendment saying that a builder is developing a building and a housing project under a scheme for affordable housing. Affordable housing means there are some guidelines set up by the government of India for a affordable housing project. If according to that guidelines, if an builder is setting up a housing project, in that case whatever capital expenditure he is incurring, he can claim it as deduction. So this point came in Income Tax Act on in budget 2011. Therefore, it is applicable with effect from 1st April 2011. Point number 7 we have completed. Let's move on to point number 8. Production of fertilizer in India. Production of fertilizer in India. In that videos which I sent you, one video, in that one video, the news channel was reporting that farmer committed suicide because of not supplying the fertilizer to him on time. See, in India, the fertilizer is available to the farmer at a subsidized cost, and those fertilizers are distributed to farmers at the distribution centers. The way we have ration shops, similarly we have fertilizer distribution centers. So farmer would go to a fertilizer distribution center and he would purchase the fertilizer from there at a subsidized price. So if you don't supply this fertilizer to the farmer on time, then his crop will get destroyed and he will suffer losses. So there were a lot of such incidents wherein fertilizer was not available to the farmer at the right time, as a result of which farmer incurred the losses and a lot of farmers committed suicide. Thereafter, government studied this situation and government came to know that the production of fertilizer in India is less as compared to the demand of fertilizer in India. Therefore, government came out with a point in section 35 AD. One second. Government came out with point in section 35 AD, that is point number 8, wherein government says if you set up a factory for production of fertilizer in India, then whatever capital expenditure you incur will be allowed to you as deduction. Now one student has messaged me saying that, sir, point number 6 is redundant because there is point number 7. See, point number 6 and point number 7 both are relating to housing, but they are different. Point number 6 and 7 both are related to housing, but this point 6 and 7 are different. How different they are? Point number 6 is focusing on slum rehabilitation. Means in cities wherever there is a slum, builder will take over that slum, he will demolish the slum. At that place, he will construct the building, and in that building, flats will be provided to those people who were owning the houses in slums. Flat will be provided to them free of cost, and the remaining area he will construct a tower and he will sell the flats and he will earn profits. So point number 6 is focusing on housing as part of slum rehabilitation scheme, whereas point number 7 is focusing on housing not as part of slum rehabilitation scheme. If a builder has acquired a plot of land, new plot of land, on that he has constructed the building and he is selling the flat, then also he can take the advantage of section 35 AD in point number 7. But that project should be a affordable housing scheme project. There are certain guidelines which are issued by the central government for affordable housing scheme. If the builder is taking up the housing project as per that guidelines, then we can say that he will fall into point number 7. So point number 6 and point number 7. Ronak is asking me, sir, is it necessary to remember the dates? See, Ronak, in the past, CA Institute has asked the questions in the examination specifically based on the dates only. So definitely, if possible, try to remember the dates. Definitely, you are not going to remember right away in the first time. If you read it twice or thrice, then only you will remember. But I do agree that it is very difficult to remember the dates in these provisions. But answer is, if possible, you should try to remember, because CA Institute has tested these points in the examination taking into account the date of commencement of business. So I have solved one doubt saying that point number 6 and point number 7 both are relating to housing, but they are different. Point number 6 is talking about a rehabilitation scheme. Point number 7 is talking about a new project. 0.678, all of them are over. Point number 9. Point number 9. Point number 9 talks about setting up and operating inland container depot. Inland container depot or a container freight station. I do not know whether you are aware about something called as inland container depot, whether you know what is inland container depot or not. I believe that you might not be knowing what is inland container depot. For example, this is a custom premises. This is a custom premises. Now, if you want to export the goods, either you can export the goods, either you can send the goods to other country through air transportation or sea transportation. Sea transportation, the transport charges will be very much reasonable. It will be very cheaper as compared to the air transportation. Now, say for example, what happens is in India, everywhere there is a traffic. Everywhere there is a traffic. There is a traffic on the roads also. And if you reach the seashore, wherein a lot of ships would come, they would unload the goods, they will load the goods and they will go away. In seashore also, you are having a lot of traffic. Say for example, there is a space that only 4 ships can unload the goods at the same time. Here only 4 ships can unload the goods at the same time. So, this is a port. This is a port, seaport. So, ships would come to this port and they would unload the goods. And whenever you export the goods, goods will be loaded onto the ship at the seaport and goods will be exported. Now, the point is, here we have a lot of traffic. Say for example, there are 25 ships standing here. There are 25 ships. So, ship number 25 would get a chance to unload the goods after 4-5 days. Because at a time only 3-4 ships can stand here. So, there was a survey conducted by the government of India. In that survey, they found out that if the ship is coming to India and is unloading the goods, and the new goods which are required to be exported are loaded onto the ship and ship goes away, the entire process would on an average take 3.5 days. So if a ship comes to the Indian seaport and it unloads the goods, new goods are loaded onto the ship and we leave the ship, that entire process would take around 3.5 days. This is the situation of India. But if the ship goes to the Chinese seaport, then unloading the goods and loading the new goods, all these formalities would take only around 8 to 10 hours. See what is the efficiency of Chinese people. If the ship reaches this Chinese port, then goods are unloaded, new goods are loaded and ship will leave the port within a span of maximum 8 to 10 hours. So because of this inefficiency, no ship would be ready to come to India. So government found out a reason why this thing is happening. So government realized that all the exporters, say for example, there are a lot of exporters here. This is the industrial area. There are a lot of exporters situated here. They want to export the goods. So what they will do? They will put the goods in a truck or a tempo and they will carry their goods to the custom port, seaport. There the goods will be inspected, then goods will be packed as per the requirement of customs, and then it will be loaded onto the ship. Ship will be provided with the clearance, and once the clearance is provided, ship can go. So all these custom formalities were being taken care of in the custom premises itself. So formalities were yet to be completed and ship was ready here. Ship was waiting for the goods to be loaded. As a result of which, formalities were getting completed at the same time and ship was waiting for the goods to be loaded onto the ship. As a result of which, it takes 3.5 days for a ship to come to India, unload the goods and take the new goods and go away. Therefore, government to improve the efficiency, to ensure that the turnaround time for the ship is very less, government came out with an idea saying that what we will do now, we will not ask these exporters to take their goods to the seaport. Instead, we will make one ICD here in the industrial area itself. ICD, inland container depot, will be made here. So these exporters will take their goods, they will go to the inland container depot. In that inland container depot, there will be a custom officers. Those custom officers, they will inspect the goods, they will do the packing of the goods as per the requirement of the customs, and then goods will be given to the ICD only. ICD, inland container depot. After the inspection and completing custom formalities, they will send the goods by their own vehicle to the seaport. Means when the goods reaches the seaport, the custom formalities are already done. Custom formalities are already done. So the moment ship arrives in India, ship arrives at the seaport, only thing which is required to be carried on is loading the goods. All other custom formalities are already over. That is the reason government came out with a concept of inland container depot. So, if you are a business organization, you set up an inland container depot, then government says whatever capital expenditure you might have incurred for setting up an inland container depot or a container freight station can be claimed as deduction by you. Now I am on to point number 10 and 11. These both points came in 35 AD in budget 2012. See, I am talking about somewhere around Diwali of 2011. See, during Diwali, sweets are made in most of the houses in the country. Sweets are made by every household. So during Diwali, there is a huge demand for sugar. And during the Diwali of 2011, the prices of sugar went up from 30 rupees per kg to 47 rupees per kg. In a span of around 1.5 months, only in a span of 1.5 months, prices of sugar went up from 30 rupees per kg to 48 rupees per kg. So sugar is a commodity which would be consumed in every household. If the prices increase by 40-50% in a span of 1.5 months, and that too during the festival period, then people would not accept this. So, to tackle this situation, government first of all analyzed why the prices of sugar have went up from 30 rupees to 48 rupees in a span of just 1.5 months, that too during a festival season. Government came to know that in India, there are a lot of sugar factories. They manufacture sugar and they supply the sugar. They don't have the huge storage facility. See, storage of sugar would require a special warehouse. Sugar cannot be stored in a normal warehouse. If it catches the moisture, then no one is going to purchase that sugar. So, storage of sugar would require a warehouse with certain special kind of facilities, and there is a shortage of such warehouse. Therefore, what the factories are doing, they are manufacturing the sugar, and once the sugar is manufactured, they would supply to the market. So, they don't store the sugar. As a consequence of which, when there is a high demand during the festival period, they are not in a position to supply the adequate quantity, and since they are not in a position to supply because they have not stored, the prices would shoot up. Therefore, government came out with an amendment in 2012. In budget 2012, government came out with an amendment saying that if you set up and operate a warehousing, if you set up a warehousing facility for what? For storage of sugar only. Sugar storage would require a special kind of facilities. Sugar should not catch moisture, etc. So these things are required to be taken care of. Therefore, government came out with a separate point in section 35D saying that if you set up and operate a warehousing facility for storage of sugar, whatever capital expenditure you incurred for setting up that warehousing facility will be given to you as deduction. Along with point number 11, point number 10 was also introduced in the section 35ID in the same year, which says that beekeeping and production of honey and beeswax. Beekeeping and production of honey and beeswax. See, in few cases, honey can be used as a substitute for sugar. Honey can be used as a substitute of sugar, and honey is also having a lot of medicinal properties. But in India, there are very less number of giant companies into honey production. For example, you have Dabur honey, but Dabur is not only manufacturing honey. Dabur is not only into honey business, they are into all the products. So you don't have big companies who are exclusively focusing on production of honey. Any activity, if you don't take up on a large scale, you will not get the benefit of economies of large scale. So government said that honey can be used as a substitute of sugar, and India, we should give incentive for the production of honey on a large scale. Therefore, government came out with an amendment saying that if you set up the business, which business? Beekeeping and production of honey and beeswax. In that case, whatever capital expenditure you have incurred, this can be claimed as deduction while computing your PGBP income. So this, we have completed 11 points out of 14 points, only 3 are left. So let's move on to next point, that is point number 12. Point number 12 talks about laying and operating a slurry pipeline for transportation of iron ore. See, there are coal mines, na? There are coal mines. Similar to coal mines, there are iron ore mines. So from mines, you extract the iron ore. From mines, you extract the iron ore. Then you take that iron ore and send it to factory for processing. From mines, iron ore would be loaded onto a truck, and that truck will transport the iron ore to the factory for the purpose of processing. Steel, etc. will be made out of it. But the point is, mine is not a very small place. Mine is a very big place. It is a very big area. So, explosive things are used for blasting the mine, and the iron ore is extracted. Once the iron ore is extracted, workers would put up the iron ore in the container, and they would put up the container on their head, and they will make a human chain from the mine till the truck. So there will be a human chain which will be made. Say for example, 50 people are there in the human chain. So everyone would pick up the container and he will give that container to the next person. In that manner, the iron ore will be taken out from the mine and it will be put it onto a truck. 50 people are employed in this. Instead, government says, you set up some pipeline system for transportation of iron ore from the mine till the point where the trucks are standing. See, in airport, you have a conveyor belt. In airport, you have a conveyor belt. So luggage will be put onto that conveyor belt, and it will automatically reach at a point where the passengers are standing for the collection of their baggage. Similar to that, if you develop a conveyor belt system or a pipeline system, wherein the moment you extract the iron ore, you put that iron ore on a conveyor belt, and that iron ore will reach at a place where the truck is waiting. So in that case, those 50 people would not be required. And this activity of taking the iron ore from the mine till a place where till the point where the truck is waiting for the iron ore to get loaded onto it, 50 people will not be required. Activity will be done on a very faster pace, and there will be huge advantage of it. Therefore, government says, if you lay and operate a slurry pipeline means you are setting up a slurry pipeline, you will transport the iron ore from the mine till the point where the trucks are waiting, trucks are standing. Till this point, iron ore will be put it into that slurry pipeline and it will reach the destination. So basically this is pipeline kind of thing. If you set up that, then you can claim deduction for capital expenditure. This point came into section 35AD only in 2014. Next is point number 13. Setting up and operating a semiconductor wafer fabrication manufacturing unit in accordance with the guidelines set up by guidelines prescribed by the government. See, what do you mean by setting up and operating semiconductor wafer fabrication unit? See, earlier also I told you that in India there is huge population of young people, and day by day younger generation population is going to increase. So we would require more number of mobiles, more number of laptop, more number of electronic things, etc. So there will be a huge demand for the hardware, and in mobiles as well as laptops and other electronic devices, you always have a semiconductor chip. In the computer we call it as motherboard. That is nothing but a semiconductor chip. So every mobile, any electronic device or computer would have a semiconductor chip. Most of the semiconductor chips are manufactured in China, and we are importing those semiconductor chips to India. So now the point is, if we go on importing this semiconductor chip throughout our life, then we'll not have money to import the capital goods, and we would be dependent always on other countries. So government had an intention to ensure that this semiconductor chip manufacturing business should be incentivized. Therefore, government came out with an amendment in budget 2014 saying that if you set up a factory in India for manufacturing a semiconductor chip, whatever capital expenditure you have incurred, that will be allowed to you as deduction. This is point number 13. Now we move on to the last point, which came in section 35 AD in the year 2017, which is recent one. Developing or maintaining. See, here if you refer it carefully, they are talking about three things. First of all, they are using the word developing. First of all, they are using the word developing. Then they have written or. Then they are writing maintaining and operating. Once again they have written or. And then they write developing, maintaining and operating. So first, 1.1, you are engaged only in developing. Point 2, you are not engaged in developing. You are engaged in maintaining and operating. And point 3 says you are engaged in developing, maintaining as well as operating, all the three activities. So either you are engaged in only one activity, that is developing, or you are engaged in maintaining and operating, or you are engaged in all the activities at the same time, that is developing, maintaining and operating. Developing, maintaining, operating what? New infrastructure facility. New infrastructure facility. What do you mean by infrastructure facility? Infrastructure facility would include, number 1, construction of road including toll road, bridge or a rail system. See, nowadays you see in lot of cities metro trains are started. So any company who sets up a metro train, they would require huge amount of investment. So for giving some incentive to them, government has come out with an amendment in section 35 AD, which says that if you build a road including the toll road, bridge or a rail system, that would be considered as an infrastructure project. Number 2, you build a highway. In that highway, housing is also part of it. Housing is also an integral part of development of highway. So any SSC who is into the business of constructing of highways or operating and maintaining the highway, or constructing, operating and maintaining a highway, will be eligible to claim deduction under section 35 AD for the capital expenditure. So number 1, development of roads. Number 2, development of highway projects including housing. Highway project including housing. Number 3, water supply project, water treatment system, irrigation project, sanitation and sewerage system, or solid waste management system, all this would be considered as part of what? Part of infrastructure facility. And the last one, if you build a port, seaport or airport or an inland waterway means for traveling from one place to another within the same country, you have developed an inland waterway, inland port or navigational channel in the sea for the transportation. This project will also be considered as part of new infrastructure facility. So the word infrastructure includes development of roads, development of highway, housing being integral part of development of highway, water supply project, or you have taken up the development of port, airport, etc. All this would be considered as infrastructure facility, and those SSCs who are engaged in the business of developing an infrastructure facility or maintaining and operating an infrastructure facility or developing, maintaining and operating an infrastructure facility, they can claim deduction for the capital expenditure which they might have incurred for this project. Who can claim deduction? Only company can claim deduction. In all other points, now starting from point number 1, if you refer in the column of eligible SSC, most of the places we have written any person, means individual HCF form, everyone can claim deduction. But in this point number 3 and point number 14, point number 3 and point number 14, only Indian company can claim the deduction. Other SSCs cannot claim deduction because this would require huge amount of investment, and only companies can make such a huge amount of investment. So here we have understood the list of 14 businesses. If you incur any capital expenditure for setting up these businesses or for operating these businesses, then you can claim deduction for the capital expenditure incurred. Rizwan is asking me a question, sir, what do you mean by he opts with effect from assessment year 21-22? Rizwan, I wanted to just tell you that these words, he opts, these words are inserted by budget 2020. So they are made applicable from assessment year 21-22, previous year 2021. Means earlier, up to last year, he was not required to exercise an option. Now this year onwards, if you want to go for the benefit of section 35D, you have to exercise the option. And I already told you that if you exercise an option for section 35D and you claim investment based deduction, then you cannot claim income linked deduction. So SSC has to decide whether he wants to claim investment based deduction or whether he wants to claim income based deduction. Rizwan, have you understood? So it is not mandatory for the SSC to go for section 35D. Instead of that, if he wants, he can go for some other income based deduction and avoid taking the investment based deduction. So it is an option left to him, he has to decide. In financial management subject, you might have gone through a chapter called as capital budgeting. In capital budgeting, you for every project, you decide what is you estimate what is the cash inflow, what would be the cash outflow. Similarly, here also cash outflow and cash inflow will be estimated over a span of time, and it will be decided whether it is beneficial for the SSC to go for investment linked deduction or it would be beneficial for the SSC to go for income based deduction. Do you recollect in the chapter of capital budgeting, you have learned something called as payback period? Yes? Do you remember something called as payback period? You have learned a concept of payback period. Yes or no? Capital budgeting chapter is over for you, right? Yes? Are you getting my voice? So in capital budgeting chapter, you might have learned something called as payback period. What do you mean by payback period? Payback period means the period in which you will be in a position to recover the entire cost of investment. For example, let me give an example. If you have not learned something called as payback period, let me give you an example. Say for example, I am into a transportation business. I am into a transportation business. I have acquired a vehicle. I have acquired a four-wheeler for a cost of say 10 lakh rupees. And out of that, I am going to earn an income of 4 lakh rupees per annum. I have acquired vehicle for how much? 10 lakh rupees. Using that vehicle in my business, I can generate an income of 4 lakhs per annum. So the question is, how much period it would take, what time for me to recover my investment? That is nothing but 10 lakh total investment divided by 4 lakh per annum, you will get 2.5 years. So in a period of 2.5 years, you will be in a position to recover the entire initial investment. So this 2.5 years period will be called as a payback period. So payback period means the period in which you will be in a position to recover the entire amount of initial investment. I am trying to make you understand that whether SSE wants to claim investment linked deduction, means section 35D, or he wants to claim income based deduction, means other sections, wherein the deduction will be calculated based on the amount of income earned by the SSE. Whether he wants to go for investment based deduction or whether he wants to go for income based deduction, he will decide based on the payback period. He will decide based on what? He will decide based on the payback period. For example, there is one section, section 10AA. In section 10AA, you can claim income based deduction. Government says for 15 years you will have a tax holiday. For 15 years, we will not charge you any tax. Now, for example, a particular business is covered by section 35AD also, and it is covered by section 10AA also. See, I explained at the beginning, you have two types of section. One section would give you investment linked deduction, the other section would give you income based deduction. At the initial stage only, you have to decide whether you want to go for investment linked deduction or whether you want to go for income based deduction. Now the point is, see, this whatever I am discussing is a part of financial management, is not part of income tax. Just to make you understand, I am explaining this, not relevant for the examination purpose. Listen to me very carefully. Say for example, in this income based deduction, you are having a tax holiday for 15 years. You are having a tax holiday for 15 years. So if you set up a particular business, then whatever income you earn for 15 years, government is not going to levy any tax. In that case, you would like to definitely ascertain the payback period. Say for example, at the initial stage you invested 10 crores into your business. So in what a period of time you will be in a position to recover back those 10 crores. If the payback period is, say for example, 8 years. If the payback period is 8 years, means in a span of 8 years, you will be in a position to get back your 10 crores which you have invested in your business. Means your payback period is payback period is 8 years. If your payback period is 8 years, then from 9th year onwards, that profit would become taxable. If you go for investment based deduction, then whatever money you have invested, that amount will be allowed to as deduction. Over a period of time, you will earn profits, and against profit, you will go on claiming the deduction. Your entire initial investment, you are going to recover in a span of 8 years, means from 9th year onwards, your profits are going to become taxable. But if you go for the second option, that is income based deduction, then you will enjoy tax holiday for a span of 15 years. So which one would be more beneficial? In simple language, we can conclude that if the payback period is less than 15 years, then the second option, that is income based deduction, would be more beneficial. Whereas if the payback period in your business is more than 15 years, then it would be advisable for you to go for investment based deduction and not income based deduction. I do not know whether you understood or not, but this is a point. This is the manner in which the projects are analyzed before making the investment. Have you understood something? I tried to explain you SSE should, whether he should go for the investment based deduction or whether he should go for income based deduction. How he will decide? He will forecast his future cash inflows, etc. Based on that, he will decide. Is that very, very clear? Yes? What about others? Manoj has given me dropped me the message saying that Manoj, let me explain by giving an example. First option is what? Investment based deduction. Investment based deduction. Say for example, you invested 10 crores in your business in year number 1. So if you go for investment based deduction, what will happen? You will get deduction in section 35AD. Section 35AD, you will get deduction. How much deduction? 10 crores. You don't have that much amount of profit in your business, but you will claim deduction of 10 crores. Thereby your income will turn out to be negative. This negative will be carried forwarded in the future, and in future once again from the same specified business you will earn profit, and this negative amount will be adjusted. In other words, till the time you recover this 10 crores from your business, till the time you recover back this 10 crores, till that time we are not going to levy any tax on you. Once your entire 10 crores are recovered, thereafter whatever profits you earn would be made taxable to you. Thereafter whatever profit you earn would be made taxable to you. This is the first option. This is the first option, means you claim what? You claim investment linked deduction. What is the second option? Second option is you claim income based deduction. What do you mean by that? When you invest money, you are not going to get any deduction. You do business, you earn a profit, and we will not levy you tax for 15 years. So from year number 1 till year number 15, whatever profits you earn out of the business, these profits will not be taxable. So question is whether investment linked deduction would be beneficial or investment or income based deduction will be beneficial. Which one would give you more benefit? So I told that it all depends upon the payback period. If the payback period is say 8 years, means whatever money you have invested, in our example you have invested 10 crores in your business now. That 10 crores you will be in a position to earn the profit of 10 crores in a span of 8 years. That is what is your expectation. In that case, if you go for first option, that is investment based deduction, then once you recover entire amount of 10 crores from the business in a span of 8 years, from 9th year onwards your profit is going to get taxable now. From 9th year onwards your profit will become taxable. But instead of that, if you go for second option, you will enjoy tax holiday for 15 years. You will enjoy tax holiday for 15 years. So which option would be more beneficial for you? Definitely the second option will be more beneficial. Manoj, have you understood? Yes? Okay. So this is actually not part of income tax, this is part of financial management, but I have tried to explain it. So we have completed the list of 14 businesses. Now we'll want to understand how much deduction is allowed, when it is allowed, in what manner deduction is allowed, etc. See, whatever capital expenditure you incur for setting up these 14 businesses will be allowed 2 years deduction. So the deduction expenditure incurred is divided in two parts. Number 1, pre-commencement expenditure, and number 2, post-commencement expenditure. Pre-commencement expenditure means all the capital expenditure incurred before the commencement of business. And number 2 is post-commencement expenditure, means once you have set up the business is already started, then also you are going on doing the capital expenditure, still you can claim the deduction. So for the purpose of claiming deduction, this capital expenditure can be of two types. Number one, capital expenditure incurred during pre-commencement period, before the commencement of business. And number two, capital expenditure incurred after the commencement of business. Both the capital expenditure, whether it is incurred before the commencement of business or after the commencement of business, you can claim deduction under section 35 AD. But in which year you will get the deduction, that is the question. So point 1 says, if the capital expenditure is incurred after the commencement of business, this we can call it as post-commencement capital expenditure. Post-commencement capital expenditure means capital expenditure is incurred after the commencement of business. Deduction for this capital expenditure will be allowed on accrual basis. Deduction will be allowed in the year in which capital expenditure is incurred. In other words, deduction will be allowed on which basis? Deduction will be allowed on accrual basis. What about the second point, that is pre-commencement expenditure? Pre-commencement expenditure means what? You have incurred a capital expenditure before the commencement of business. Then in which year you will get deduction? In that case, you will get deduction in the year in which the business is commenced. You will get deduction in the year in which business is commenced. So it says deduction is allowed in the year in which operations of the business are commenced, provided the condition is this capital expenditure should be capitalized in the books of accounts. It should be capitalized in the books of accounts. If you don't capitalize, you are not going to get any deduction. So, post commencement expenditure will be allowed as deduction on accrual basis in the year in which expenditure is incurred, and pre-commencement expenditure will be allowed as deduction in the year in which business is commenced, provided that capital expenditure is capitalized in the books of accounts. Hopefully these points are clear to you. Now I move on to one very important note. Very important note. If you recollect, yesterday while discussing section 32, I explained you that government wants to ensure that all the transactions should take place in India through the banking system. So yesterday I told you that while explaining the definition of actual cost, I discussed with you one point wherein I said that if you acquire a asset, if you are acquiring an asset, if the value of the asset acquired is more than 10,000, then the payment to the vendor should be made by account pay check, account pay bank draft, ECS, debit card, credit card, RTGS, NEFT, BHIM, UPI, etc. In other words, payment should be done in an electronic mode. Payment should be done by electronic mode. If you make payment in cash, or if you make payment by bearer's check, or if you make payment by cross check, then what will happen? Then we will not allow you to add the cost to the block of asset. And if we do not allow you to add the cost to the block of asset, then what will happen? Then deduction will not be allowed to you for depreciation. Then deduction will not be allowed to you for depreciation. So, similar point is there in section 35 AD also. In section 35 AD also, there is a similar point. It says what? If you have incurred a capital expenditure, and the amount of expenditure is how much? More than 10,000. It exceeds 10,000, then deduction will be allowed to you under section 35 AD. Deduction will be allowed to you under section 35 AD, provided you make the payment to the vendor either by way of account pay check, account pay bank draft, ECS, debit card, credit card, RTGS, IMPS, BHIM, UPI, etc. In other words, payment should be routed through a bank. If you have acquired an asset for a specified business, you have incurred a capital expenditure for a specified business, but the payment to the vendor is made by cross check or bearer check, or payment is made in cash, then for that amount we are not going to give you any deduction. Hopefully friends, this point is very much clear to you. Similar point we had already discussed while discussing the definition of actual cost in the concept of depreciation. Now let's move on to the last part of the section, and that is conditions to be satisfied for availing deduction under section 35 AD. Conditions to be satisfied for availing deduction under section 35 AD. Very quickly, I will explain you these conditions. Number 1, no deduction in case of restructuring of existing business. No deduction in case of restructuring of existing business. Let me take an example to make you understand what is the meaning of this condition. For example, in point number 1 in section 35D, they say that if you set up a cold chain facility, then whatever capital expenditure you might have incurred, you can claim it as deduction, provided this cold chain facility business is commenced on or after 1st April 2009. Now say for example, I was already into the business of cold chain facility even before this section came into existence. I was in the cold chain facility business right away before 2009 itself. So question is, can I claim deduction under section 35D? Answer is no. Why? Because the section says that you set up a new business and you commence a new business on or after 1st April 2009, then only you are eligible to claim deduction. So if already I am having an existing business, I cannot take the advantage of section 35D. But those people who are already into these specified businesses before the commencement of section, definitely they would try to manipulate the things to claim the deduction. For example, I was already into a cold storage business right away before 2009. Name of my company was, say for example, J Private Limited, and we were into cold storage business. When I started the cold storage business, this point was not in existence. So I could not claim deduction for capital expenditure. But this point came into existence in budget 2009. It was made applicable with effect from 1st April 2009. So what I did now, after introduction of this point in section 35 AD, I formed a new company, say B Limited. Then entire business of J Limited was sold off to B Limited. So B Limited is a new entity. B Limited is formed only after 2009. So what I will do? I will claim deduction for this cold storage facility in the hands of B Limited. Government says we will not allow you deduction in such a manner because you have not set up a new business. The existing business is taken over by some new entity. So what you are doing is business restructuring. Only the entity is changed. Business remains the same. That is the old business only. Therefore, we are not going to give you any deduction in section 35 AD. In section 35 AD, we will give you deduction only if you set up a new business. If the existing business is restructured by doing amalgamation, demerger, etc., then we are not going to give you any deduction under section 35 AD. In simple language, government tells you that don't fool us. Don't fool us. If you try to fool us, we are not going to give you deduction. You set up a new business. By taking over the existing business, we are not going to give you any deduction under section 35 AD. So friends, in this condition, we have completed the first condition. Second condition says, the business should not be set up by transfer of second-hand plant and machinery. Out of any of these 14 businesses, whenever you set up any business, definitely all the businesses would mostly require the plant and machinery. But here we are saying that business should not be set up by purchase of second-hand plant and machinery. In other words, deduction under section 35 AD will be available only if you acquire first-hand plant and machinery. Second-hand plant and machinery, if you acquire, no deduction under section 35 AD. If you recollect, if you acquire the second-hand plant and machinery, also you are not eligible to claim additional depreciation. So similar condition is inserted here also. Third point says second-hand plant and machinery up to 20% of total plant and machinery is okay with us. So say for example, your total investment in plant and machinery is say 10 crores. What is 20% of 10 crores? 2 crores. So government says if the old plant and machinery old plant and machinery, if it is up to 2 crores, then it is okay with us. Then we will give you section 35 deduction. But if the old plant and machinery is more than 20% of total plant and machinery, then you will not be eligible to claim deduction under section 35 AD. So, for claiming deduction under section 35 AD, you should set up a business by purchasing new plant and machinery. But old plant and machinery to the extent of 20% is acceptable. So if you set up the business by old plant and machinery, and that old plant and machinery is up to 20% of total plant and machinery, government says you will get deduction under section 35 AD. Point number 4 says second hand imported plant and machinery will be considered as new machinery only. So you have imported machinery from some other country and it is a second hand machinery. Then that second hand machinery will not be considered to be a second hand machinery, it would be considered to be a first hand machinery. In other words, the imported old machines will be considered as new machine only, as if they are new machines. So while you check the condition that your old plant and machinery should not exceed 20% of total plant and machinery, that imported plant and machinery should not be taken into account, because imported machinery would be deemed to be a new machinery only. So if you purchase a second hand machinery from outside India, then it would be considered as a new machinery. If you want to claim deduction under section 35 AD, then audit of books of accounts is mandatory, and once the audit is done, you are required to submit the audit report. Audit report is required to be submitted. Then only you will be eligible to claim deduction under section 35 AD. Now see this point, actually this is there in the module, but from examination point of view, this point is having very less relevance. Still, I would read this point and try to explain you, but from examination point of view, you can mark this as unimportant point. This is not relevant for examination. See the first business now, out of the list of 14 businesses, what was the first business? Not the first one, sorry, third one. What was the third business? Laying and operating a cross-country natural gas, crude or petroleum pipeline. For that, you will be eligible to claim deduction provided certain conditions are fulfilled. What are the conditions? That is what we need to understand. In that note, condition is written. Let us try to read what is that condition. Usage of pipeline capacity should be available to a person other than SSE and person other than associated person. See, some capacity of that cross-country natural gas, crude or petroleum pipeline, for example, through that pipeline, you can transport, say, 1 lakh tons or 1 lakh liters of crude oil. 1 lakh liters of crude oil can be transported using that pipeline. Then that 1 lakh liter capacity, now out of that, some capacity should be available for use by other persons. Some capacity should be available for use by other person, because in some unexpected situation, private organization should not say that we have set up this pipeline, so will not allow any other person to use. For example, right now, you know that there is a shortage of oxygen. So oxygen is being transported by filling into tankers. Instead of that, say for example, there is a pipeline through which the oxygen can be transferred from one place to another. In that case, government says you have set up a pipeline, we gave you deduction also, but we will give you deduction subject to the condition that some capacity of that pipeline should be available for usage by the third parties and the government. Then only you will be eligible to claim deduction under section 35 AD. Now let us try to read this. Point says SSE will have to make 1/3 of its natural gas pipeline network capacity or 1/4 of total petroleum pipeline capacity, 1/3 for natural gas and 1/4 for petroleum pipeline 1/3 and 1/4 capacity respectively should be made available for use on a common carrier basis. Common carrier basis means other people will be allowed to use that. Definitely you can charge money for that, but that much amount of that much capacity should be available for use by third parties on a common carrier basis by any person other than SSE or an associated enterprise. So associated enterprise means a person related to SSE. So SSE and person related to SSE, other than these two people, 1/3 capacity, 1/4 capacity should be available for usage by other people. Then only you will be eligible to claim deduction under section 35 AD. Hopefully friends, this condition is very much clear to you, but not relevant for the examination. Now let's move on to point number 4, no deduction for depreciation. If you claim deduction for capital expenditure in section 35 AD, then you can't claim deduction for depreciation, otherwise that would amount to double deduction. So we don't intend to give you double deduction, therefore we are saying that once you have claimed deduction for capital expenditure in section 35 AD, we will not allow you deduction for depreciation. Point 5 says no double deduction for the specified business. If you have claimed deduction under this section for that same capital expenditure, you can't claim deduction in any other section. You can't claim deduction in any other section. So we are not going to give you a double deduction for the same capital expenditure. Now friends, we are going to discuss very important point. Actually it is connected, this point is connected to section 28. If you remember, while I explained to section 28, now one point I did not explain you, saying that this point will be covered when we discuss section 35 AD. So now it is the time to discuss section 28, one point which we had left. Now for example, you had incurred a capital expenditure of 10 crores on plant and machinery for a specified business. That entire 10 crores we will allow you as deduction. That entire 10 crores we will allow you as deduction. So that 10 crores now you have claimed as deduction. So entire cost of plant and machinery of 10 crores was given to you as deduction. Thereafter you have sold some machinery. In that case, the selling price of machinery would be taxed to you under section 28. So I am repeating, you have acquired any asset, in other words you have incurred a capital expenditure, for that you have claimed 100% deduction in section 35 AD. Thereafter, if you sell off the asset and you realize money, that amount is going to be taxed to you under section 28. So point number 6 says tax treatment of asset destroyed, demolished, discarded, transferred. Any capital expenditure in respect of which deduction was allowed under section 35 AD, that asset is destroyed, demolished, discarded, or that asset is transferred, then the cost of acquisition or purchase of such asset will be considered to be zero, and that amount will become taxable to you under section 28. Entire amount will become taxable to you under section 28. Hopefully friends, this point number 6 is very much clear to you. Now we move on to the last point, that is point number 7, 8 and 9. See point number 10 now, I will be explaining you when we move on to the chapter of set off and carry forward. So right now I will not explain you this. Point number 10 will take up when we move on to the chapter of set off and carry forward. Right now I don't want to mix up the PGBP chapter with set off and carry forward. So point number 10 we will keep it as pending. Point number 7, 8 and 9, they are connected to each other. Point number 7 is section 35 AD subsection 7A. Point number 8 is section 35 AD subsection 7B. And point number 9 is section 35 AD subsection 7C. Let me take an example to make you understand. Section 35 AD subsection 7A, subsection 7B and subsection 7C. For example, in the list of 14 businesses, there was one business, hotel business of 2-star and above category. Now say for example, Inside Commerce Studies, or say for example Inside brand, Inside is into two businesses. Inside is into two businesses. Number one, it is into hotel business, and number two, it is into coaching business. It is into coaching business. Now, Inside is into two businesses, hotel business as well as coaching business. You know that hotel business of 2-star and above category is covered by section 35 AD. So, if you incur any capital expenditure, then you can claim deduction in section 35 AD. Deduction is allowed in section 35 AD for capital expenditure incurred for a hotel business. But what if you have incurred some capital expenditure for a coaching business? Then section 35 AD deduction is not allowed. Section 35 AD deduction is not allowed. So, what such people used to do? Those people who had two businesses, one was covered by section 35D, the other one was not covered by 35D. What they used to do now? They used to fool the government and claim reduction for other businesses also. Non-specified businesses also, they used to fool the government and claim reduction. For example, I want to install an AC in the coaching class. In the coaching class business, I need an AC. If I acquire an AC for a coaching class business, I am not going to get any deduction in section 35D. But yes, I can capitalize the value of that AC and claim depreciation deduction over a period of year. But depreciation deduction will be available to me over a period of lot of years now. Section 35AD will give me deduction for the entire cost of AC right away in the first year. So intentionally, I would acquire an AC for the hotel business. Intentionally, on paper, I would acquire an AC for which business? Hotel business. Thereafter, I would claim the deduction for the entire cost of AC in the hotel business in section 35AD. In section 35AD, I would claim the deduction for the entire cost of the AC in the hotel business. Once I have claimed deduction in section 35AD now, what I will do now? Next year, I will transfer this AC from the hotel business to coaching business, and I'll set up this AC in my classroom. In other words, what I did now, I fooled the government. How I fooled the government now? I acquired an asset for a specified business, but I did not have an intention to use that asset for a specified business. Right from day one, I had an intention to acquire an asset for a non-specified business, but I know that if I acquire an asset in non-specified business, I won't be getting a deduction for the entire cost in the first year itself. I need to capitalize and claim depreciation deduction over a period of years. So intentionally, I acquired an asset in a specified business. I acquired the asset, I claimed the deduction for the entire amount. Thereafter, in the next year, I transferred the asset from my specified business to non-specified business. What is happening as the result of doing such thing? The business which is non-specified, now for that business also, I am indirectly claiming deduction for the cost of entire asset. But this was not the intention of the government. Now, we are fooling the government in claiming the deduction. Therefore, government came across such a situation in a lot of instances, and therefore government came out with an amendment, and government inserted section 35AD subsection 7A, section 35AD subsection 7B, and section 35AD subsection 7C. What it says, let us try to understand by taking an example. Say for example, I purchased an AC air conditioner costing 1 lakh rupees. If this AC is acquired for specified business, if this AC is acquired for specified business, then in section 35 AD, I would get deduction. How much deduction? Deduction for the entire cost of AC, that is 1 lakh. And in that case, I won't get any depreciation. Section 32 depreciation will not be allowed. What if this AC is acquired for non-specified business? If this AC is acquired for non-specified business, then I won't get any deduction in section 35 AD because section 35 AD is not applicable. In that case, I should capitalize the cost of this AC and I should claim deduction in section 32 AD in the form of depreciation. But intentionally, I wanted to claim deduction for the entire amount right away in the first year. So what I did, I actually acquired the asset in the specified business. I claimed the entire deduction in 35 AD. Thereafter, in the next year, I transferred the asset from the specified business to non-specified business, thereby claiming the deduction for the entire cost at one go. Government came across such instances, and for preventing people from doing this, government came out with section 35 AD subsection 7A, section 35 AD subsection 7B and section 35 AD subsection 7C. First is section 35 AD subsection 7A. In section 35 AD subsection 7A, government says, if you acquire an asset for a specified business, then it is mandatory for you to use that asset for a specified business for a span of 8 years. If you acquire an asset for specified business, that asset should be used for specified business for a period of 8 years. In other words, you should not transfer that asset from specified business to non-specified business before 8 years. What if you transfer the asset from specified business to non-specified business before 8 years? Then we would withdraw the deduction. That is what is written in section 35 AD subsection 7B. Section 35 AD subsection 7A says what? It says, whatever asset you acquired in specified business should be used for specified business for a period of 8 years. In other words, it should not be transferred to some other non-specified business before the expiry of 8 years. The next section is section 35 AD subsection 7B. It says what? If you have transferred the asset from a specified business to a non-specified business before expiry of 8 years, then what will happen? That is what we need to discuss in section 35 AD subsection 7B. Now, for example, if this AC would have been acquired right from day one, for non-specified business, means coaching business, then what would happen? 1 lakh is the cost of an asset. But if I acquire this asset for non-specified business, I am not going to get any deduction for the cost of an asset. I will get depreciation deduction. Now, what is the amount of depreciation? Let me take a simple example saying that the rate of depreciation in section 32 for AC is 10%. Actually, it is not 10%, actually it is 15%. Then in which year will the deduction be allowed in this case? Oh, let me explain the entire point. Don't worry about that. Once I complete the discussion, you will understand everything. Thereafter, if you don't understand, then please do ask. If you acquire the AC for hotel business, what will happen? The entire cost of 1 lakh will be allowed to as deduction under section 35 AD. If you acquire the asset for, say, coaching business, AC is acquired for coaching business, then what will happen? In first year, you will get depreciation. Say, for example, depreciation is 10%. So, in year number 1, you will get depreciation 10,000. What will be the WD of year number 2? 90,000. Year number 2, what will be depreciation? 9,000. WD method. Huh? Then the WD at the beginning of year number 3 will be 81,000. This is the manner in which deduction will be allowed in the form of depreciation if the asset is acquired for a non-specified business. Now, what happens is, intentionally you are acquiring the asset into specified business, you are claiming deduction for entire 1 lakh, and then you are transferring that asset at the beginning of year number 3 from specified business to non-specified business. So question is, have you transferred the asset from specified to non-specified before the expiry of 8 years? Answer is yes. In that case, what will happen? Government says you take up the original cost of an asset, actual cost of an asset. From that, deduct the depreciation for the expired period. In which year the asset was transferred from specified business to non-specified business? No, it was transferred from specified business to non-specified business in year number 3. So what is the expired period? Expired period is 2 years, year 1 and year 2. You deduct the depreciation for year number 1 and year number 2. If I deduct the depreciation for year 1 and year 2, I would arrive at the WDV of 81,000. Government says, as per section 35 AD subsection 7b, this 81,000 would be taxable to you. As per section 35 AD subsection 7b, this 81,000 would be taxable to you. And thereafter, this 81,000 you can go and add to your block of asset. This 81,000 you can go and add to your block of asset, and then you claim depreciation in the normal manner. See, if this asset would have been acquired for specified business, you might have claimed deduction for entire 1 lakh. You intended to acquire the asset for coaching business, but you intentionally acquired the asset into the hotel business with the intention to claim the deduction for entire amount of 1 lakh. So you have claimed the deduction for 1 lakh right away in first year itself. Thereafter, in year number 3, you have transferred the AC from the hotel business, which is a specified business, to the coaching business, which is a non-specified business. So government says you give the treatment as if the AC was acquired for the non-specified business right from day 1. If the AC would have been acquired for non-specified business right from day 1, then you would have got depreciation for 2 years. Till now, you would have claimed depreciation for 10,000 plus 9,000, that is 19,000. So if you would have acquired the AC for the coaching business right from day 1, you would have got deduction of 19,000 till now. But you have already claimed deduction for 1 lakh rupees. So how much excess deduction you have claimed? 81,000. This 81,000 will be added to your PGBP income. It will be taxed to you as per section 35 AD subsection 7b. Thereafter, this 81,000 you can go and add to your block of asset. In which business? Coaching business. And then you can go on claiming depreciation in the normal manner as part of the block of asset. As part of the block of asset. This is what is written in section 35 AD subsection 7b. So I have completed the discussion of section 35 AD subsection 7a and section 35 AD subsection 7b. Is that very, very clear? Yes. Is that very clear? Gaurav, have you understood this? Okay, okay. So we have covered up section 35 AD subsection 7a and we have covered up section 35 AD subsection 7b. Now we move to the last section of section 35 AD, that is section 35 AD subsection 7c. Section 35 AD subsection 7c. Listen to me, what it says. See, what is the consequence of section 35 AD subsection 7b? I took an example to make you understand. What you have understood by this? What is the consequence of section 35 AD subsection 7b? 81,000 will be added to your income. 81,000 will be added to your income, and this 81,000 then you can add it to the block of asset and claim depreciation. But at once 81,000 will be added back to your income and tax will be levied on 81,000. Now government says, see in Hindi we have an idiom. In Hindi we have an idiom. मरे हुए को क्यों मारना? मरे हुए को क्यों मारना? Means, why to kill a person who has already died? There is no point of shooting a person who has already died. I am just wasting my bullets. So why to do such thing? So government says 81,000 would generally be added to your PGBP income and tax will be levied to you. But if you are a sick company, if you are a sick company. Do you understand sick company? Sick company means a company whose liabilities are more than the assets. That company will be called as a sick company. So in section 35D subsection 7C, government says this treatment which we discussed in section 35D subsection 7B, as a result of which 81,000 is being added to the income of the SSE and tax is levied, this treatment will not be given in case of a sick company. Because sick company anyway they are having financial difficulties. If we add this 81,000 to their income and we levy the tax, they will face more difficulties. So why to kill a person who is already killed? Why to waste my bullets? That's what government says in section 35AD subsection 7C. So section 35AD subsection 7C says that section 35AD subsection 7B na taxability discussion would not be applicable to a sick company. So with this, friends, we have completed the discussion of section 35AD, subsection 7A, subsection 7B, as well as subsection 7C. With this, section 35AD comes to an end. With this, section 35AD comes to an end. So we have discussed 35AD today. So with this section 35AD, the entire bunch of section which is allowing you deduction right from section 30 to section 38 are over. Right from section 30 to section 38 are over. I move on to section 40 capital A subsection 2. Section 40 capital A subsection 2. See, we have already completed the entire bunch of section which was allowing you deduction for the expenses. Those were right from section 30 to section 38. Those were right from section 30 to section 38. Now we will be moving on to a section which is disallowing you deduction. Which is disallowing you deduction. So in those sections, government will say that if certain conditions are not fulfilled, then deduction will be denied to you. Deduction will be denied to you. So in that we are moving on to the first section, section 40 capital A subsection 2. Now to make you understand section 40 capital A subsection 2, I am going to take a very simple example, and with the help of that example I will explain you section 40 capital A subsection 2, and then we will discuss section 40 capital A subsection 2, what are the provisions. Now say for example, I am a practicing chartered accountant. I am having my own office. In my office, I have taken Manoj as article assistant. After your CA intermediate, you do articleship, na? So Manoj is doing articleship in my office. So ideally, say for example, Manoj is my real brother. Manoj is my real brother. He is doing chartered accountancy course and he has completed his CA intermediate. So now he is looking for a articleship in a CA firm. So instead of looking somewhere else, I offered him a articleship in my own CA firm. Now, if you do articleship, what is the normal stipend which you will get? 1,000 rupees per month, 2,000 rupees per month, max 3,000 rupees per month. I offered a articleship to Manoj in my CA firm and I am paying him a stipend of say 25,000 rupees per month. The first year article, yearly stipend does not exceed 25,000. I am paying Manoj 25,000 per month. Every month I am paying a stipend of 25,000. Is it justified? If I pay a stipend of 25,000 per month, yearly I am paying 3 lakh to Manoj. Ideally, based on the skill set which he is possessing, he should be getting maximum 3,000 rupees per month. So around 36,000 in a year. Instead of 36,000, I am paying him how much? 3 lakh rupees per annum. This 3 lakh rupees will be debited to my profit and loss account and I would claim deduction for that. This 3 lakh would be debited to my profit and loss account and I would claim deduction for that. Income tax officer says income tax officer says that my child has also completed CA intermediate. He is also looking for an articleship where he can get a stipend of 25,000. So will you offer articleship to my child? I said, no, I don't have requirement in my office. So he said, no, it is not the question of requirement. Why you are paying 25,000 stipend to Manoj, na? Because Manoj is your brother. The only reason why you are paying more stipend to Manoj is because he is your brother. So you intentionally are paying more amount to him so that you can get more deduction. Your income will be less, tax liability will be less. On the other hand, Manoj does not have any other income. So Manoj will have an income of 3 lakh rupees. Out of 3 lakh, 2.5 lakh would be exempted in basic exemption limit. Beyond 3 lakh, 50,000 will be taxable at 5%. That too he can claim rebate under section 87A. Thereby his tax liability will be 0. So here what we are doing, intentionally we are incurring more expenditure. We are paying something more to our known person. We are paying something more to the known person. So section 40 capital A subsection 2, section 40 capital A subsection 2 says, if you have incurred an expenditure, and you are supposed to pay an expenditure to your known person, if you pay something which is more than the market price, that amount will be disallowed to you. How much amount will be disallowed? Excess amount will be disallowed. How much amount will be disallowed? Excess amount will be disallowed. For example, how much is reasonable? 3,000 per month is reasonable. So what is the yearly amount reasonable? 36,000 yearly is reasonable as per the market requirement. Based on the skill set which Manoj is possessing, he should be eligible to get only 36,000. I am paying him how much? 3 lakhs. What is the extra amount paid to Manoj? 3 lakh minus 36. 3 lakh minus 36 means 2,66,000 extra amount is paid to Manoj. This is extra or this is excess as compared to market. As compared to the market, I can easily get an article assistant just by paying 3,000 rupees. So I am paying him extra because he is my brother. So that extra amount will be disallowed to me. Have you understood this? Yes. Have you understood this example? So I move on to section 40 capital A subsection 2. Section 40 capital A subsection 2 says what? Section 40 capital A subsection 2 says, if you have incurred an expenditure and you are making payment to your relative, means known person. If you have made some extra payment, that extra amount will be totally disallowed. To you. Now let us refer to the provision in detail. So you have section 40 capital A subsection 2 in front of you, which says excess or unreasonable payment made to a known person. Known person means a specified person. What do you mean by specified person? Meaning is given here. That will refer. So if you are making a payment to whom? To a specified person, and you have made some extra payment, excess payment or unreasonable payment, then the extent to which that payment is unreasonable, to that extent it will be disallowed to you. While computing your PGBP income. So here there is an SSE, and here we have a specified person. This specified person is selling goods or rendering services or providing facilities. To whom? To the SSE. So from a specified person, either you have purchased goods or you have purchased services or you have taken up facilities. In that case, you are supposed to make payment to the specified person, na? So you are making payment for the above. So you have purchased goods, that is the reason you are making payment to the specified person, or you have taken up some services from the specified person, or specified person has provided you certain facilities, and that is the reason you are making some payment. if that payment is reasonable, having regard to the fair market value, then deduction will be allowed. Deduction will be allowed, meaning thereby section 40 capital A subsection 2 does not have any role to play. Section 40 capital A subsection 2 has a role to play only when the payment is excess or unreasonable. In that case, section 40 capital A subsection 2 says excess amount or unreasonable amount will be disallowed to you. If the payment for such transaction is excess or it is unreasonable, having regard to the fair market value, or legitimate business needs, or based on the benefit derived by the assessee. If you have made excess payment as compared to the benefit derived by you, in that case what will happen? Excess or unreasonable payment will be disallowed. Excess or unreasonable payment will be disallowed to you. Now the question is, what do you mean by specified person? Excess or unreasonable payment made to a specified person will be disallowed. But the question is, what do you mean by specified person? If the assessee is individual, see in my example, I was the individual. I made some excess payment to Manoj. So Manoj is a specified person for me. What do you mean by specified person? In connection with individual, specified person means a relative. Specified person means a relative. Now you may ask a question, sir, what do you mean by a relative? So definition of relative is also given here. Definition of relative is also given. A relative in relation to individual includes following. Devdarshini says, sir, what do you mean by legitimate business needs? What do you mean by legitimate? I have been asked a doubt, sir, what do you mean by legitimate business needs? Legitimate business needs means, say for example, right now, during this COVID period, everyone is ready to work from home. But I want some person who can work from my office. I want some person who is ready to work from my office. I want to hire an employee for doing audit. Generally, if the environment is normal, I can easily get an employee if I pay a remuneration of 25,000 per month. But in this COVID times, no one is ready to work from the office. Everyone is ready to work from home. So I offered a remuneration of 35,000 to anyone who is ready to work from my office. So I am paying how much extra? I am paying extra 10,000. But is it legitimate to pay extra? Yes. Why? Because at 25,000 I could not find an employee to work now. In a normal environment, I can find out an employee easily for 25,000 per month. But because of COVID, no one is ready to travel. And work from office. So I paid 10,000 extra to an employee who was ready to travel to audit location. So have I paid extra because he was my relative? No. Because the situation is demanding the extra payment. If I wait and if I go on searching the employee who is ready to work for 25,000, my business will be affected, na? My client will not be satisfied. That is the reason I could not find an employee at 25,000, so I paid 35,000. So that 10,000 extra will not be disallowed because my business is demanding more payment. I could not find out an employee at 25,000. That is the reason I have paid 35,000. So we say that extra is paid, but it is legitimate because situation is demanding. Yes, have you understood this? Yes or no? So every time that extra payment will not be disallowed. It will be disallowed only if it is paid to relative it is paid excess and my business needs are not demanding to make an extra payment. If I am paying extra because of my business needs, in that case nothing will be disallowed to me. In that case nothing will be disallowed to me. Now let's move on to the definition of specified person. If the SSE is an individual, then specified person means a relative of an individual. So say for example, this is myself. For me, who all would be considered as relative for the purpose of section 40 capital subsection 2 na? My wife will be considered as my relative. My spouse would be considered as my relative. My real brother and real sister would be considered as my relative. So at the beginning only, while I gave you an example saying that I am paying extra money to Manoj, I told you, Manoj is my real brother. So for me, number one, my spouse is a relative. Number two, my brother is a relative. Number three, my sister is a relative. See, we are not talking about cousin brother and cousin sisters. We are not talking about cousin brother or cousin sister. We are talking about real brother and real sister. Are you understanding? Brother, sister from the same parents. So, this real brother and real sister would be considered as your relative for the purpose of section 40 capital subsection 2. Point number 4, lineal ascendant. Do you understand lineal ascendant? Above the line. Lineal ascendant means previous generation. Your father, your grandfather, those will be called as lineal ascendant. Then lineal descendant. Lineal descendant means below the line. Below the line means next generation. Means your son, your daughter, they will be considered as lineal descendant for you. So point number 5 is lineal descendant. So this is the definition of relative. Relative in relation to an individual includes number 1, spouse, number 2, brother, real brother of individual, number 3, real sister of individual, number 4, lineal ascendant of an individual, and number 5, lineal descendant of an individual. If you are making excess payment to them, then excess will be disallowed. Excess will be disallowed only if the excess payment is made to a specified person in relation to an individual. Specified person means a relative of individual. Yes, is that very, very clear? Next point, in relation to an individual, specified person means a relative. Who all would be considered as a specified person in relation to HUF? In relation to HUF. Now Devdarshan is asking me the question, sir, step brother, step sister will be considered as brother sister? What is the case? What is the situation when it comes to step brother and step sister? See, law is silent on this. But I believe that step brother, step sister should be ideally considered as your brother and sister for the purpose of section 48(2). That is what I believe, because they are also near to you, they are also close people close to you. So step brother, step sister should be considered as your relative only. So let's move on to next. In case of HUF, all the members of HUF, and their relatives, in case of HUF, all the members are considered as specified person, and relative of member is also considered as a specified person. So if HUF is making some excess payment to member, or HUF is making some excess payment to relative of member, that excess payment will be disallowed. Next is if SSE is firm. For firm, partner would be considered as a specified person, and all the relatives of partner would also be considered as a specified person. Do you understand? Relative of partner. Relative partner means spouse of partner, brother, sister of partner, lineal ascendant and lineal descendant of partner. So for firm, partner and their relative would be considered as a specified person. If the SSC is AOPBY, then all the members would be considered as specified person, and relative of member will also be considered as a specified person. If the SSC is a company, then all the directors would be considered as a specified person, and relative of director will be considered as a specified person. So for example, Manoj is a director in one of the company, and in that company, Manoj's wife is offered an employment at 50,000 rupees per month. Manoj is a director in one of the company, and in that company, Manoj's wife has been offered an employment at 50,000 rupees per month, and Manoj's wife is only 10th standard clear. 10th standard clear, that's all. Her education is SSC, 10th standard. Do you believe that a person who has just cleared 10th standard can get a job at 50,000 rupees per month? No. So Manoj's wife has got a job because of Manoj's influence. She might have got job because of Manoj's influence. So we say that for a company, director is a specified person and the relative of director is also a specified person. So whatever excess payment company has made to Manoj's spouse will be considered as amount disallowed under section 40 capital A subsection 2. Now we want the point number 6 and 7. See, for different SSC we have different specified person. We have a definition of specified person which is applicable. But in this definition of specified person, we have a common point here. Point number 6 and point number 7 is a common point. It is applicable in case of all persons. So whether the SSC is individual, HUF, firm, company, association of person or body of individual, this point number 6 and point number 7 will be made applicable to all SSCs. Will be made applicable to all SSCs. So who all are covered in point number 6 and point number 7? This is SSC. SSC can be any person, individual, HUF, firm, company, any person. If SSC is having 20% or more shares or 20% or more profit sharing ratio in some other entity, if SSC is holding 20% or more in some other entity, that other entity will become a specified person for the SSC. For example, I am an individual. There is one company, XYZ Limited. In that XYZ Limited, I am holding 20% or more shares. I am holding 20% or more shares. In that case, that XYZ Limited will be considered as a specified person for me. If I make any excess payment to XYZ Limited or director of XYZ Limited or relative of XYZ Limited, that excess payment will be disallowed to me. That excess payment will be disallowed to me. Other way around, say for example, my company is a private company, J Private Limited. My company is a private company, J Private Limited, and there is one more company, XYZ Private Limited. That XYZ Private Limited is holding 20% shares in my company. Like XYZ Private Limited is holding 20% shares in my company. In that case also, we both would be considered as a specified person for each other. See, for Manoj, his wife is considered as a life partner, na? So for Manoj's wife, Manoj should also be considered as a life partner. It cannot happen that Manoj is a life partner for his wife and for his wife, someone else is a life partner. That cannot happen. If two individuals are there, now both will be considered as husband and wife for each other. So both should be considered as life partner for each other. So similarly, if I am holding 20% in someone or other way around, someone else is holding 20% in me, na, in both the situation, we both are considered as a specified person for each other. In this case, SSC is owning 20% in some other entity in point 6, and point 7, some other entity is holding 20% or more in the SSC. In both the cases, they would be considered as a specified person for each other, and if you make any excess payment to a specified person, that excess amount will be disallowed. Yes, have you understood this? Okay. So Manoj has asked me doubt. Manoj has asked me a doubt. See what doubt he has asked me. A machine is purchased for 1 lakh and claimed deduction under section 35 AD after 3 years, then that machine comes into normal business. At what value machine should be taken into accounts? See Manoj, books of accounts we are not concerned with that. If you acquired a machine for 1 lakh rupees, an entire 1 lakh rupees you have claimed deduction under section 35 AD, thereafter you transfer the machine from your specified business to any other business. After 3 years you have transferred now. So you take a piece of paper, on that write the value of machine, say 1 lakh rupees. From that you go on deducting depreciation for 3 years. Once you deduct the depreciation for 3 years, whatever value is arrived now, that value will become taxable to you, and that same value you can add to the block of asset to non-specified business and you can claim depreciation. See Manoj, on the screen you can see an example wherein, say for example, you acquired the machine for 1 lakh rupees and for entire 1 lakh you claim deduction in section 35 AD. That machine was used for specified business for 2 years and later it was transferred to non-specified business. In that case, what will be added to the income is 81,000 will be added to the income while computing PGBP income, and 81,000 would also be taxed to you under that PGBP. 81,000 you go and add to the block of asset and claim depreciation. We are not concerned with what is going to happen in the books of accounts. Books of accounts, capital expenditure is appearing in the balance sheet asset side. If you get deduction in 35, that doesn't mean that capital expenditure will be debited to your profit and loss account. It will still be there in the balance sheet asset side only. So don't take into account what is going to happen in books of account. We are not concerned with what is going to happen in books of accounts. Yes, Manoj, have you understood? Okay. So let's move on. We have completed section 40 capital A subsection 2. So I'll just show you the notes. We are on page number 136 in your notes. Excess payment to relative. Excess payment to relative or a substantial interest holder will be disallowed as per section 40 capital A subsection 2. First point says excess or unreasonable expense will be disallowed. Second point says unreasonable or excess amount shall be determined having regard to the fair market value. So number one, excess or unreasonable amount will be determined having regard to fair market value. It will be determined having regard to the legitimate needs of business, and it will be determined having regard to the benefits derived. See, I had taken example wherein I had hired Manoj in my office as an article and I have made the excess payment. Such kind of excess payment can take place in any transaction. For example, my supplier has supplied me the goods and I have paid him something more than the market price of the goods. In that case also there can be an excess payment. Point 3 gives you the meaning of specified person. Important points to be noted. Meaning of substantial interest means either as an SSC you are holding 20% or more in any concern, or any other concern is owning 20% or more in you. Point number 2, important point to be noted is disallowance will affect only the payer. Disallowance will affect the payer, not the payee. Pictorial presentation of section 40A2. Now before we move on to next section, that is 40A3, let us just have a look at this pictorial presentation. Expense is divided in two categories. The expense for which deduction is allowed. Expense for which deduction is allowed, meaning thereby this expenditure is covered by section 30 to section 37(1). This expenditure is covered by section 30 to 37(1). Then we can say that this expenditure belongs to the deduction allowed category. This expenditure belongs to the deduction allowed category. Deduction not allowed means there is a specific section which says that deduction will not be allowed. So, section 48(2) is applicable only to those expenses. Section 40 capital subsection 2 is applicable only to those expenses for which ideally deduction is allowed. Means those expenditure are covered by section 30 to section 37(1). If the pay is not a relative, then section 48(2) is not applicable. If section 48(2) is not applicable, then deduction is allowed because this is a negative section. If the condition is fulfilled, deduction will be disallowed. If condition is not fulfilled, deduction will be allowed. If pay is relative, but payment is not excess or not unreasonable, then also deduction will be allowed. So, one line conclusion is, for disallowing deduction in section 40 capital A subsection 2, pay should be a relative, pay should be a specified person, and payment should be excess. Both conditions are required to be fulfilled, then only deduction will be disallowed. And how much deduction will be disallowed? Excess amount will be disallowed. Excess amount will be disallowed. So 48(2) we completed before the break, and after the break we have referred to that provision from the notes. Shruti madam says that screen is not visible. Screen is now visible to you? Now okay na? Okay. Okay. Now we move on to section 40 capital A subsection 3. This is the most important section. We are going to discuss in very much detail, and this will be very helpful to you when it comes to your articleship. In articleship, during articleship. Okay. Superb. So let's move on to new section, that is section 40 capital A subsection 3. Section 40 capital A subsection 3. Now listen to me carefully. We will refer this provision from the notes, directly from the flow chart first of all. Once again we move on to a section disallowing the deduction. We are moving on to a section which is disallowing the deduction. I already explained you yesterday itself also and today also. Same point I explained you yesterday while explaining you the definition of actual cost, and today also I explained you the same point in section 35 AD, saying that if you have acquired any capital asset or you have incurred any capital expenditure, that capital expenditure can be claimed as deduction in section 35 AD, provided if the amount of expenditure is more than 10,000, the payment to the vendor should be made by account pay bank draft, account pay check, etc. So payment should be made electronically, then only deduction is allowed. In other words, if the payment is made in cash, or the payment is made by bearer check, or the payment is made by a cross check, then deduction will be disallowed to you. Such point we have discussed while discussing depreciation also, and we have also discussed in section 35 AD also. But here, now we have a separate section exclusively for this. It is giving you the same provision, but this will be applicable for other expenditure. Other expenditure means other than 35 AD and other than section 32. So here, to understand this, the reason behind the provision I have already explained you yesterday. That if you do any transaction, you are incurring an expenditure. It is an expenditure for you, but for the other person it is an income. And if you make payment in cash to him, that the other person will have an opportunity to evade the tax. He may not disclose that amount received in his income, and he may avoid the payment of tax. Thereby, you are creating an opportunity to evade the tax for the other person. Therefore, government says, we will disallow you the expenditure. Government says, we will disallow you the expenditure if you are making payment in cash, or you are making payment by a cross check, or you are making payment by a bearer check. That will be disallowed. So let us try to understand this provision in detail. For that I have divided the expenditure in two parts. Those expenditure for which deduction is allowed, meaning thereby those expenditure is covered by section 32, section 37. This section 40 capital A subsection 3 is applicable only when the expenditure is covered by section 30 to 37. Any expenditure which is not covered by section 30 to section 37, for that anyway deduction is not allowed. For that anyway deduction is not allowed. If your expenditure is not covered by section 30 to section 37(1), anyway deduction is not allowed. There is no need to apply section 48(3). If the expenditure is not covered by section 30 to 37(1), for example, you have incurred some personal expenditure. Can you claim deduction for personal expenditure while computing your business income? Answer is no. So for that expenditure, even if you make payment by account paycheck, deduction is not going to be allowed, because anyway that expenditure is not allowed as deduction. So if the deduction is not allowed, if the expenditure is not covered by section 30 to 37, deduction is anyway not allowed. There is no need to apply 48 through section 40. There is no need to apply section 40 capital A subsection 3 to it. Without applying the provisions of section 48(3), that expenditure will be disallowed. So if personal expense is debited to your profit and loss account, anyway it is going to get disallowed, whether you make payment by account paycheck or you make payment by cash. It doesn't make any difference. Without applying the provisions of 48(3), that expenditure is going to get disallowed. So in this case 48(3) is not applicable. Without applying 48(3) only, deduction is disallowed. So deduction will not be allowed. But 48(3) provision will not be applied. Further, if the expenditure is covered by section 30 to section 37(1), if the expenditure is covered by section 30 to section 37(1), in that case, we say that if you have made the payment by account paycheck to the vendor, person from whom you have purchased the goods, or person from whom you have acquired the services, or person from whom you have acquired the facilities, you are going to make payment to him, that expenditure will be debited to your profit and loss account, you will claim deduction, we will allow you deduction, provided while making payment to that person, you are making payment either by account paycheck drawn on a bank, or you are making payment by account pay bank draft, or you are making payment by use of electronic clearing system through a bank, or you are making payment through such other electronic mode as may be prescribed. What do you mean by other electronic mode? What do you mean by other electronic mode? Government has inserted rule 6A(BBA). Government has inserted rule 6A(BBA), wherein government says the word other electronic mode would include, other electronic mode shall include payment by credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and BHIM. All these are payments by electronic mode that is allowed. That is allowed. So if you have incurred an expenditure, if that expenditure is covered by section 30 to section 37(1), deduction will be allowed, provided you are making payment by account paycheck or account pay bank draft or ECS or debit card, credit card, NEFT, BHIM, UPI, RTGS, etc. If the payment of such expense is done by any other mode, what do you mean by any other mode? Any other mode will include number 1, payment in cash, number 2, payment by bearer check, and number 3, payment by cross check. If you make payment by cash, payment by bearer check or a payment by cross check, then what will happen? Then government says if transaction is covered by rule 6DD, then section 40 capital subsection 2 will not apply and deduction will be allowed for the expenditure. Deduction will be allowed for the expenditure. But if the transaction is not covered by Rule 6DD, Section 48(3) will be applicable and deduction can be disallowed for the expenditure. Basically, we will apply Section 48(3). We will apply Section 48(3) to which transactions? Which transaction? The transactions which are not covered by Rule 6DD. See, Rule 6DD is consisting of transactions entered into a special situation. For example, I want to make payment to my vendor and today bank is closed and there is a strike in the bank for 5 days. So 5 days throughout the country, all banks are closed. So is it possible for me to make payment by account pay check? Will it be realized for the other party? The answer is no. So this situation is kept in an exception in Rule 6DD. So Rule 6DD says if the banks are closed either because of holiday or because of strike etc. and in those days if you make payment in cash, then we will not apply Section 48(3) because it is an exceptional situation. We will not apply Section 48(3) means deduction will be allowed for the expenditure. So we are saying that if you have made the payment by cash, if you have made payment in cash or you have made payment by a bearer check or a cross check, but your transaction is covered by Rule 6DD, it is covered by the exceptional situation. In that case, Section 48(3) would not be made applicable to you. In that case, nothing will be disallowed. In that case, nothing will be disallowed. Yes, is that very, very clear? We have not discussed Rule 6DD with you, but as of now, I am just telling that if the transaction is covered by Rule 6DD, it is covered by the exceptional situation. And if it is covered by the exceptional situation, then Section 48(3) will not be made applicable. If Section 48(3) is not applicable, in that case, entire expenditure will be allowed as deduction. Entire expenditure will be allowed as deduction. Now let's move on to this part. Transaction is not covered by Rule 6DD. If transaction is not covered by Rule 6DD, then what? Then you should have made a payment by account pay check, account pay bank draft, etc. If you have made payment in cash, etc., then that amount of expenditure will be disallowed to you. But that is explained in detail in Note 1. That is explained in detail in Note 1. See, there is some of the information is appearing on page 138 and some is appearing on page 139. Actually, this entire table should be on page number 139 only. Because of some formatting issues, this has taken place. So, we are referring to Note 1. Note 1 will be applicable when? Note 1 will be applicable only when the transaction is not covered by exceptional situation. Transaction is not covered by Rule 6DD. Note 1 is giving you two conditions. Note 1 is giving you how many conditions? Two conditions. We are saying that if first condition is fulfilled, first condition is not fulfilled and second condition is fulfilled, then deduction will be allowed for the expenditure. If first condition is not fulfilled and second condition is fulfilled, then deduction will be allowed for the expenditure. Second possibility is first condition is fulfilled but second condition is not fulfilled, then also deduction will be allowed for the expenditure. Third possibility, first as well as second, both the conditions are not fulfilled. First as well as second, both the conditions are not fulfilled, still expenditure will be allowed as deduction. Please understand, this is a negative section. This is a negative section. If the conditions are fulfilled, the deduction will be disallowed. If the conditions are fulfilled, deduction will be disallowed. In other words, if condition is not fulfilled, deduction will be allowed. Now, fourth possibility is first condition as well as second condition both are fulfilled. First condition as well as the second condition both are fulfilled. If first as well as second condition both are fulfilled, in that case we say that deduction will be disallowed to you. Deduction will be disallowed to you. Now let us try to understand what this first condition and second condition is. First and second condition says what? First condition says each expenditure should be greater than 10,000 rupees. Each expenditure should be greater than 10,000 rupees. In other words, if the transaction value is less than equal to 10,000, then this section will not apply. If transaction value is less than equal to 10,000, then section will not apply. What is the meaning of section will not apply? You make payment by any mode, deduction will be allowed to you. You make payment in cash, then also deduction will be allowed if the value of the transaction does not exceed 10,000. See, I can't, practically it is impossible to say that every transaction should happen through the banking system only. It is not possible. A very small transaction we can't do through banking system. So, government has kept a limit. If the transaction value is up to 10,000 rupees, then what? Then you make payment by any mode, we will allow you deduction. We will allow you deduction. Okay, let us continue. Okay. Now, I am in section 40 capital subsection 3, I am saying that if two conditions are fulfilled, then the expenditure will be disallowed. In other words, it will be added back to the income. So you have debited the expenditure to your profit and loss account. You are claiming the deduction. If two conditions are fulfilled, then expenditure will be disallowed. What are those conditions? The first condition says each expenditure should be more than 10,000 rupees. In other words, if the transaction value itself is less than equal to 10,000, then 48.3 will not apply. If 48.3 is not applicable, you can make payment by any mode, including cash. Even if you make cash payment, that will also be allowed as deduction. So when we say each expenditure is more than 10,000 means the transaction value should be more than 10,000. Each expenditure means you have to look at single expenditure. See, one bill is one expenditure. If you purchase goods from a supplier and you have received two different bills then you have to look at one bill at the same time. One bill is one expenditure. Every expenditure should be looked at it independently, individually. If the amount of expenditure is more than 10,000 and the amount of payment is also more than 10,000, expenditure is more than 10,000, payment is also more than 10,000, both the conditions are fulfilled. Then section 48.3 will apply and the entire expenditure will be disallowed. Section 48.3 will be applicable and the entire expenditure will be disallowed. Now for example, you have purchased goods from your supplier. For say 50,000 rupees and supplier has sent you a bill of 50,000 rupees. And you are making a cash payment of 10,000 on a particular day at 9 a.m. in the morning. Once again, you are making the cash payment to the same person on the same day, but at 10 a.m. So you purchase goods worth 50,000 from your supplier and you are making payment of 50,000 in cash, but that payment is made in 5 installments of 10,000 each during the day at different times. 10,000 cash is paid at 9 o'clock, 10,000 cash is paid at 10 o'clock, 10,000 cash is paid at 11 a.m., 10,000 cash is paid at 12 noon, and 10,000 cash is paid at 1 p.m. in the afternoon. So the transaction is how much? More than 10,000. Have you made single payment or multiple payment? Definitely multiple payment. 5 payments you have made. But all these payments are on the same day. If all these payments are on the same day, you have to take up the aggregate and see the condition. You have to take up the aggregate. You have to take the total. If the total expenditure, if the total payment is take up the total of all the payments made in a day. And that too, which payments? Which are paid either in cash or by cross check or by bearer check. If you make payment by account pay check, then we don't have any issue. If you make payment in cash or cross check or a bearer check, then there is a problem. If you are making multiple payments, 10,000 each, in the same day you made 5 payments in cash at 5 different times on the same day against the same bill, then we will take up the aggregate to check the second condition. We will take up the aggregate to check the second condition. So second condition point B says you take the aggregate payments made in a day for the same expense. If the aggregate payments are more than 10,000, then we can say that second condition is also fulfilled. If the first condition is fulfilled as well as second condition is fulfilled, deduction will be disallowed for the expenditure. See, now naturally a lot of questions would arise in our mind saying that what if there is more than one expense, what if I make payment partly by account pay check, partly by cash, etc. All these situations will be covered in the form of an example. See, just below that I have taken example and I have taken 9 different situations. Everything will be discussed in detail. So you will not have any doubt at the end of the discussion. Now, but before I move on to these different situations, let me summarize this section for you. Let me summarize the section. Expenditure is divided in 2 parts. Those expenditure for which deduction is allowed, they are covered by section 30 to section 37(1). To those expenditure, 48(3) can be applied. And those expenditure for which anyway deduction is disallowed, to those expenditure, section 48(3) cannot be applied. 48(3) cannot be applied. Because without applying 48(3) itself, this amount of expenditure will anyway be disallowed. For example, personal expenditure will be disallowed irrespective of whether you are making payment in cash or whether you are making payment by an account pay check. Personal expenditure is anyway going to get disallowed. Now, if it is a business expenditure, which is covered by section 30 to section 37(1), if you are making payment by account pay check, account pay bank draft, ECS, etc., then nothing will be disallowed irrespective of the amount. But if you are making payment by any other mode will include cash payment, payment by bearer check or a cross check. In that case, what will happen? If the transaction is covered by the exceptional situations given in Rule 60D, then section will not apply. Entire expenditure will be allowed to as deduction. If the transaction is not covered by the exceptional situation, then section will be made applicable. If the section is made applicable, then you have to check 2 conditions. Which are those conditions? The amount of expenditure should be more than 10,000. The amount of payment should also be more than 10,000. If both the conditions are fulfilled, then entire expenditure will be disallowed to you. Entire expenditure will be disallowed to you. Hopefully, this is very much clear to you. So now we move on to the examples, illustrations. So let's move on to first example. See, here I have put it in serial number. This is the first example. Date of bill is 1st July 20. You have purchased, say for example, you have purchased goods from your supplier and the date of bill is 1st July and the bill number is 11. Bill number is 11 and the amount of bill is 25,000. Amount of bill is 25,000. And you have made a payment in cash. You have made payment of 25,000 in 3 installments. 8,000 is paid on 10th of July, 8,000 is paid on 11th of July, 8,000 is paid on 12th of July. And all the payments are in cash. Now the point is, can you tell me, do you believe that each expenditure is more than 10,000? Do you believe that the first condition is fulfilled? Expenditure is more than 10,000? Definitely yes. The amount of expenditure is 25,000. Each bill is an expense. Each bill is an expense. So, we can definitely say that since this amount is 25,000, condition 1 is fulfilled. Condition 1 is fulfilled. Now, you have 3 different payments. And if you look at the amount, every time you have done the payment, the amount does not exceed 10,000 rupees. Amount does not exceed 10,000 rupees. And these are different payments made on different dates. So in a single day, you have never made a payment of more than 10,000 in cash. In other words, payment does not exceed 10,000. Payment does not exceed 10,000. So condition 2 is not fulfilled. Condition 2 is not fulfilled. If condition 1, condition 2 both are fulfilled, then the expenditure will be disallowed. Condition 1 is fulfilled, 2 is not fulfilled. So what will happen? Deduction for the expenditure will be allowed. So entire expenditure of 25,000 will be allowed. Entire expenditure of 25,000 will be allowed as deduction. Is that very, very clear? Now we move on to the second example. You have acquired goods, you have purchased goods from the supplier on 1st July 20. 1st July 20 is the date of bill. The bill number is 25, bill number is 11. Amount of bill is 25,000. All the payments you have done in cash, and the amount paid is 10,000, 10,000 and 5,000. These are paid on 10th July, 11th July and 12th July. Tell me, what is going to happen? Expenditure is more than 10,000? Yes, it is 25,000. So first condition is fulfilled. Second condition, have you made payment in cash? Yes. But look at the amount. All those payments are made on a different date, and the amount of payment, single payment you have to take, single payment. That single payment does not exceed 10,000. See, the first and the second payment is exactly 10,000. For condition to be fulfilled, the payment should be more than 10,000. Only when the payment is more than 10,000, we say that condition 2 is fulfilled. So here condition 2 is not fulfilled. Condition 1 is fulfilled, 2 is not fulfilled. What will happen? Deduction for the expenditure will be allowed. Deduction for the expenditure will be allowed. So here we are saying that entire expenditure of 25,000 will be allowed as deduction. Will be allowed as deduction. So we have completed example number 2 as well. See, I am discussing different examples with you. The moment you get it out, you should drop me a message. If you don't drop me a message, it is implied that yes, you have understood. So we have completed example number 1 and we have also completed example number 2. Now I move on to example number 3. 1st July is the date of bill. 1st July is the date of bill. Bill number is 11. Amount of bill is 25,000. You have made payment in cash in 3 installments of 11,000, 11,000 and 2,000. Payment is made on 10th July, 11th July and 12th July respectively. So you have acquired goods worth 25,000. So the expenditure is more than 10,000 rupees. And this 25,000 is paid to your supplier, paid to the vendor in 3 installments. And those 3 installments are paid on 3 different dates. But if you look at the first and the second installment, the first payment and the second payment, the amount is more than 10,000 rupees. Amount is more than 10,000 rupees, means condition 2 is fulfilled. First payment of 11,000 will be disallowed because expenditure is more than 10,000. Payment is also more than 10,000. Both the conditions are fulfilled. So what will happen? First payment of 11,000 will be disallowed. On the similar lines, second payment will also be disallowed. So the first payment is 11,000, second payment is also 11,000. Both payments are more than 10,000. So both will be disallowed. Both will be disallowed. What about the third payment? Third payment will not be disallowed. Why? Because the amount is only 3,000. Because the amount is only 3,000. So third payment of 3,000 will be allowed as deduction. Third payment of 3,000 will be allowed as deduction. Have you understood the third example? Rakesh is asking me, sir, what is the logic behind disallowing when both the conditions are fulfilled? What is the logic behind disallowing the expenditure only when both the conditions are fulfilled? See, Rakesh, if you purchase goods worth 10 lakh, if you purchase goods worth say 1 lakh rupees and you make 10 different payments on 10 different dates, it is not necessary, you will make payment on the spot. You may have a credit period of say 6 months. So over a period of 6 months, you will make one payment each. So how can we apply the conditions to the entire transaction at one go? Because transaction has not concluded at one go. So if you have purchased goods from someone and you have got a credit period of 6 months, saying that over a period of 6 months you can make payment. So partly you are making payment. So we have to apply the conditions partly only. If you make payment at one go, we'll apply section at one go. If you make payment in installment, we'll have to apply the condition in installment only. Are you understanding? And if the expenditure itself is not more than 10,000, then disallowance should not apply. See, government says small expenditure, small expenditure, small payments can be made in cash. There has to be some limit, So government has set up a limit of 10,000 rupees. Government says if the transaction value is up to 10,000, you make payment by any mode, we will not disallow you the expenditure. There has to be limit, You can't incur small expenditure in, say for example, you went to a stationery shop and you bought a stationery worth of 1200 rupees. Will you give him a check? Will he accept? So there are certain transactions, there are practical difficulties. Every transaction, payment cannot be made through banking system. Here in India, people are not habituated to make the payments online. So government says up to certain limit we will allow. So what is that limit they have set up? 10,000 rupees. So if the expenditure is less than 10,000, we will allow you deduction irrespective of how you are making the payment. But if the expenditure is more than 10,000, then we will give you deduction only if you make the payment through a banking system. And second condition, for example, you have purchased goods worth 10 lakh rupees and you have got a credit period of 6 months. Then over a period of 6 months, you are going to make the payment. Definitely you will utilize your entire credit period. Why you will make the payment at one go? When the credit facility is available to you, definitely you would like to take the benefit of that. And you are making multiple payment. So how can we apply this section at one go? Since you are making multiple payments, we have to apply this section also at a multiple occasion. Yes, have you understood, Rakesh? Yes or no? Okay, let us proceed. We move on to situation 4, example 4. Date of bill is 1st July 20. Bill number is 11. Amount of bill is 25,000. And all you have made the payment in cash. You have made first installment payment is made 11,000. Second also 11,000. Third is 3,000. So this point number 4, fourth example is similar to the third one. But what is the difference? In the third example, the amounts were paid on different dates. Amounts were paid on different dates. In the fourth example, all these 3 installments are paid on the same day, 10th July. At 9 am, 10 am and 11 am respectively. In this case, if we allow deduction in such a manner, then you can make payment of 1 crore also. You will pass first entry at 9 am, second entry will pass in the books of account at 9:1 am, third entry will pass at 9:02 am. Then the section will be useless. So if you are making payment at different times on the same date, then we are supposed to take up the aggregate. We have to take the aggregate and apply this section on the aggregated amount, total amount. So what is the total amount paid? 25,000. Entire 25,000 is paid in 3 installments, and all the 3 installments are payment is made in cash. So you take the aggregate. Expenditure is how much? 25,000. Payment is how much? 25,000. Is it paid in cash? Yes. So what will happen? Entire 25 will be disallowed. Is that very, very clear? So with this, point number 4, example number 4 is also over. Now we move on to example number 5. Example number 5, we are having 3 bills. First purchase is made on 1st July 20. Second purchase is made on 3rd July 20. Third purchase is made on 5th July 20. And we have a separate bill number 11, 15 and 17. Each bill is of only 5,000 rupees, and entire amount of 5,000 per bill multiplied by 3 bill, that 15,000 is paid at one go. 15,000 is paid at one go on 10th July 20. What is the consequence? First condition itself is not fulfilled. First condition itself is not fulfilled. The amount of expenditure itself does not exceed 10,000 rupees. So in that case, we say that what? Condition 1 is not fulfilled. Condition 1 is not fulfilled. What is the consequence? Deduction will be allowed for the expenditure. This is a small transaction. So government doesn't want to apply the section on a small transaction. Government doesn't want to apply the section on a small transaction. So example number 5 is over. Example number 5 is over. Example number 6. Date of bill is 1st July. Bill number is 11. Transaction value is 25,000. And you have paid the 25,000 on 10th of July, and this is paid by account pay check. Account pay check payment is allowed. Na? Account pay check, there is no issue. So whatever amount you pay by account pay check, section will not apply, deduction will be allowed. Situation 7. Situation 7. Example 7. Date of bill is 1st to July 20. Bill number is 11. Transaction value is 25,000. Transaction value is 25,000, meaning thereby first condition is fulfilled. Payment mode is cash, and entire cash of 25,000 is paid on 10th of July at one go. So in this case, expenditure is more than 10,000, payment is also more than 10,000. Both conditions are fulfilled. Both conditions are fulfilled. What is the consequence? Entire amount will be disallowed. Entire amount of 25,000 will be disallowed. So we have discussed 7 different instances, 7 different examples. Now before actually I move on to discuss example number 8 and example number 9. Before I move on to discuss example number 8 and example number 9, I want to explain you example number 8 and example number 9 by writing something here. Say for example, there is a supplier. From this supplier, I am purchasing goods. I am SSE. Supplier has supplied me the goods, and this supplier is my relative. This supplier is my relative. Goods are supplied. Payment is made. How much payment is made now? Say 15,000 payment is made. 15,000. How this payment is made? It is made in cash. This payment is made in cash. Now I am telling you one important ingredient of this point is the fair market value of goods supplied is 12,000. Fair market value of goods supplied equals to 12,000. Can you tell me which section will apply? Which section will apply? 48(2) will apply or 48(3) will apply? You have made a payment of 15,000 in cash and you have made excess payment to your relative. So which section should apply? Section 40 capital A subsection 2 should apply, or section 40 capital A subsection 3 should apply? Which section should apply? So answer is both the section can be applied. Both the sections can be applied. But the point is, which section should be applied first? If you apply section 40A3 first, for example, you are applying section 40A3 first, then what will happen? Entire 15,000 will be disallowed in 40A3. You will say that deduction not allowed is 15,000. Correct? 40A3 disallowance will be 15,000. The amount of expenditure itself is 15,000. You have disallowed entire amount in 40A3. So what is left to be disallowed in 40A2 is 0. What is left to be disallowed in 40A3 is 0. Sorry, what is left to be disallowed in 40 capital A2 is 0. On the other hand, second possibility is, first you are applying section 40 capital A subsection 2. If you first apply 40 capital A 2, what is the consequence? Excess payment to relative will be disallowed. How much is the excess payment? 3000 is the excess payment. That will be disallowed in 40A 2. Thereafter, you apply section 40A 3. But section 40A 3 will be applied only on the balance amount. What is the transaction value? 15,000. Out of 15,000, how much is already disallowed? Out of 15,000, how much is already disallowed? 3,000 is already disallowed in 40A 2. So, what is the balance left? Balance left is 12,000 rupees. So, this 12,000 can be disallowed in 40A 3. This 12,000 can be disallowed in 40A 3. Now, the point is whether first approach is correct or second approach is correct. Whether the first approach is correct or second approach is correct. So, the answer is second approach is correct. Second approach is correct. Why now? Because in the Income Tax Act, sections are required to be applied in a ascending order. Sections are required to be applied in a ascending order. Which section comes first? Section 40 capital A subsection 2. So, it is mandatory for you to apply section 40A2 first and then you have to apply 40A3. So, this approach is not correct. This approach is correct. Have you understood? Why the first approach is not correct now? Why the first approach is not correct? That you will understand if we take one more example. If we take one more example, you will understand why the first approach is not correct. Let me change the color and let me take one more example here. For example, goods are supplied and the transaction value is say 12,000 rupees. Transaction value is 12,000. Payment is made in cash. And the fair market value of goods is 9,000. Fair market. Are you understanding? I have changed the color, na? I have changed the color, so it is another example. I don't want to reproduce the entire information once again. I don't want to write all these things once again. So I am just changing the color and giving you second example. So what is the value of the transaction? 12,000. How the payment is made? Payment is made in cash. And what is the fair market value of goods? Fair market value of goods is 9,000. So, in this case, if you apply section 40A3 first, you will disallow entire 12,000 in 40A3. You will disallow entire 12,000 in 40A3. So, if you go for the first approach, section 40A3, you will disallow 12,000. But if you go for the second approach, then we will say that section 40 capital A subsection 2 excess payment to relative is 3,000, that is 12 minus 9. So that 40 capital subsection 2 3,000 will be disallowed and 40 capital A subsection 3 nothing will be disallowed. Why na? Why nothing will be disallowed? Because transaction value is 12,000. Transaction value is 12,000. Out of which already 3,000 is disallowed. Out of which already 3,000 is disallowed. After disallowing 3,000, what is left is 9,000. After disallowing you 3,000, what is left is 9,000. If 9,000 is left, anyway 40A3 is applicable only when the amount exceeds 10,000. 40A3 is applicable only when the amount exceeds 10,000. The transaction value was 12,000, that is correct. But out of 12,000 on an amount of 3,000, 40A2 is already applied. 40A2 is already applied. So 40A3 cannot be applied on the entire amount. It can be applied only on a balance amount. What is the balance amount? 9,000. Balance amount is 9,000. And 9,000 cash payment is anyway allowed in 40A3. So what will be disallowed in 40A3 is 0. Nothing will be disallowed in 40A3. Have you understood this? If you go for the first approach, you will disallow entire 12,000. If you go for the first approach, you will disallow the entire amount of 12,000. If you go for the second approach, you will disallow 3,000 in 40A2 and you will not disallow anything in 40A3. So which is the correct approach? Second one is the correct approach. Second one is a correct approach. Have you understood this? Yes. So what is the moral of the story? If section 40 capital is subsection 2, if section 40 capital is subsection 2 as well as section 40 capital is subsection 3, both are applicable, then it is mandatory for you to apply section 40 capital A2 first, and only on the balance amount you will apply 40 capital A3. So if 40 capital A2 as well as 40 capital subsection 3 both are applicable in the same transaction, same situation, then it is mandatory for you to apply 40 capital A2 first, and on the balance amount only you will apply section 40 capital A subsection 3. And 40 capital A subsection 3 will be applicable only if the balance amount is more than 10,000 rupees. Is more than 10,000 rupees. Hopefully friends, this is clear. Now, same examples are given here. You need not write, same examples are given here. Refer to this point. Example number 8. Date of bill is 1st July 20, bill number is 11, transaction value is 15,000, payment is made in cash, and the payment is made to a relative, fair market value is 12,000. So what is excess payment to relative? 3,000. That will be disallowed in 40 capital A subsection 2. What will be disallowed in 40 capital A subsection 3? 12,000 will be disallowed. So what is disallowed in 40A2 is 3,000. What is disallowed in 40A3 is 12,000. Same example I have given you. Example number 9. Date of bill is 1st July 20. Bill number is 11. Amount of bill is 12,000 rupees. The pay is relative and the fair market value of goods supplied is 9,000. So what is excess payment to relative? Excess payment to relative is 3,000. That will be disallowed in 40 capital A3. That will be disallowed in 40 capital A subsection, 40 capital A subsection 2. That will be disallowed in 40 capital A subsection 2. So out of the transaction value of 10,000, 3,000 is disallowed in 48.2. What is left to be disallowed is only 9,000 rupees. And section 40 capital A subsection 3 is not applicable when the amount is less than 10,000. When the amount is less than equal to 10,000, 40A3 will not apply. So 9,000 will be allowed. So in ninth situation, only 3,000 will be disallowed. Yes, is that very, very clear? Shruti madam, yes, 9,000 will be allowed as reduction. Only 3,000 will be disallowed. Yes? Okay. One more student is asking me to explain situation 4 once. Example number 4. Madam, example number 4, you have entered into a transaction. One second. See, I have tried to take multiple examples, and every example is a unique example. If you try to change the facts of any one example, then the situation will fit into some other example. If you try to change the facts of any of the example, then situation would fit into some other example. And that other example is also covered in this list. So don't worry about that. Don't try to change the numbers. Still, someone is asking me to explain example number 4. Madam, in example number 4, the amount of bill is 25,000. And the entire amount of 25,000 is paid in cash, and entire payment is made in the same day. It is paid in the same day. If you refer to the second condition, part B says that aggregate payments made in a day for the same expense. For the same expense, if you are making multiple payments on the same day, then you have to take up the aggregate. That is the reason in point number 4 we have taken up the aggregate. And what is the aggregate payment? Aggregate payment is 11 plus 11 plus 3, that is 25. That is 25. So expenditure is more than 10,000. Aggregate payment is also more than 10,000. So entire 25,000 will be disallowed. Entire 25,000 will be disallowed. Yes. Example number 4. Have you understood very clearly? Okay. Now, Shruti madam is asking me, sir, if in example number 5 itself, the amount is greater than 10,000, would it be disallowed? Example number 5. Madam, example number 5, we are having 3 expenditure, na? Example number 5, how many bills you are having? We are having 3 bills, bill number 11, bill number 15, bill number 17. Each of the bill itself is less than 10,000, na? So, you don't have one expenditure. You don't have one expenditure, you have 3 expenditure. If there would not have been 3 bills, there would have been only 1 bill. If there would have been only 1 bill, in that case, if the amount would have been more than 10, then definitely it would have been disallowed. Then definitely it would have been disallowed. Shruti madam, have you understood? Yes. Mr. Redmi, this all discussion is from the point of view of payer only. This all discussion is from the point of view of payer only. Only payer will make the payment, na? We are thinking about the payer only. Yes, Manoj says, example number 8. Manoj, example number 8, what is the transaction value? Example number 8, what is the transaction value? It is 15,000 rupees. Transaction value is 15,000. In this case, na, 40A2 as well as 40A3, both the sections are applicable. 40A2 as well as 40A3, both the sections are applicable. Which section you will apply first? Mandatorily 40A2 to be applied first. Ascending order. Sections are required to be applied in a ascending order. So, it is mandatory for you to apply section 40 capital A subsection 2 first. So, how much you will disallow in 40 capital A2? You will disallow 3,000, na? You entered into a transaction at 15,000. The market value is 12,000. So, what is excess payment to relative? Excess payment to relative is 3,000. So, that 3,000 will be disallowed in 40 capital A subsection 2. Now, what can be disallowed in 40 capital A subsection 3 is balance amount. So, you can't disallow 15,000 in 40 capital A 3. Why na? If you disallow 15,000 in 40 capital A subsection 3, then what will happen? 40A2 you disallowed 3,000, 40A3 you will disallow 15,000. So, total disallowance would be 18,000. But 18,000 you do not have the transaction of 18,000. For example, this is the bottle. I insert water here. Inside the bottle, I fill up a water. Bottle is of 1 liter only. Bottle is of 1 liter. If I put 1 liter bottle or 1 liter water in the bottle, and if I try to remove 1.5 liter, is it possible? No, it is not possible. Similarly, the transaction is entered at 15,000. What might have been debited to your profit and loss account is 15,000. So, what you can disallow to the maximum extent is 15,000. You can't disallow an amount of 18,000. So, what is disallowed in 40 capital subsection 2 is excess payment to relative, that is 3,000 rupees. After disallowing 40 capital 2, after disallowing 3,000 rupees in 40 capital subsection 2, you are left with the balance amount of 12,000. So, what can be disallowed in 40 capital 3 is only 12,000 rupees. Manoj, is that very clear? What is the total disallowance in example number 8? Na? That is what I told you. Na? Total disallowance in example number 8 would be 15,000. I cannot disallow something more than the transaction value. My transaction value itself is 15,000. So, more than 15,000 cannot be disallowed. So, 3,000 will be disallowed in 40 capital subsection 2, 12,000 will be disallowed in 40 capital subsection 3. Manoj, is that very clear? Yes or no? Okay, now with all these examples, now see, there cannot be any situation which is beyond these 9 examples. There cannot be any situation which is beyond these 9 examples. Everything is covered. Now, referring to these 9 examples, you might have understood how much amount is required to be disallowed in which section. Now, let us come back to section 48.3 And let us try to understand. Let us come back to section 43 and let us try to understand in which year expenditure will be disallowed. Right now we understood that if two conditions are fulfilled, expenditure will be disallowed. That is correct. But that disallowance would apply in which financial year? Why such question arises? Because it may happen that you might have incurred the expenditure in the current year and you are actually making the payment in the next year. This can happen. Therefore, I have taken three cases here, case 1, case 2 and case 3. I have taken three cases, case 1, case 2, case 3. What is the objective of taking three cases? To make you understand that disallowance would apply in which year. The objective of taking these three cases is to make you understand that disallowance would be made applicable in which year. So, let us refer to the first case. What I am saying in the first case is expenditure and payment both are in the current year. So, previous year 2021, you have passed an entry, expense account debit 15,000 to cash account 15,000. Tell me, whether the first condition is fulfilled, do you believe the expenditure is more than 10,000? Yes. Oh, you have made a payment in cash. So, do you believe the second condition is also fulfilled? Yes, cash payment is made 15,000 rupees. So, expenditure is in the current year, payment is also in the current year. So, you can check that yes, condition 1 is not fulfilled. You can also check that condition 2 is also not fulfilled. So, condition 1 as well as condition 2 both are not fulfilled. What is the consequence? That expenditure will be disallowed. In which year it will be disallowed? Definitely in the previous year 2021. So, while you calculate the income of the previous year 2021, this 15,000 will be added back. 15,000 will be added back to net profit. This amount will be disallowed. Have you understood this first case? Yes. Have you understood this first case very clearly? Say yes. Yes or no? Harshit, what is our purpose? What is the objective? What is the objective of putting this into cases? What is the objective? We need to understand in which year disallowance would apply. In which year disallowance would apply. So, in first case, you have passed in journal entry, expense account debit to cash account. And this journal entry is passed in previous year 2021. So, tell me, do you believe that the amount of expenditure is more than 10,000? Yes, it is 15,000. It is 15,000. Do you believe that you have made payment otherwise than by account pay check, account pay bank draft, ECS, etc.? Yes, you have made payment in cash. So, do you believe the payment is also more than 10,000? Yes. Condition 1, condition 2 both are fulfilled. So, what will happen? Amount will be disallowed. Swati madam, yes, both conditions are fulfilled, therefore 15,000 is disallowed. Harshit, have you understood this? Well, expenditure as well as payment both are made in the current year. So, disallowance would be applicable in the current year. So, this will be added back to income of which year? It will be added back to the income of 2021. It will be added back to the income of 2021. Now, have a look at second case. Second case, what is the heading? Expenditure is in the current year, payment is in the next year. Expenditure is in the current year and payment is in the next year. For example, you have passed an entry in the previous year 1920. You have passed the entry in the previous year 1920. Expenditure account debit 15,000 to parties account. To parties account means the person's account. Say for example, I have purchased goods from Manoj. On a credit basis, I have passed an entry, purchase account debit to Manoj's account 15,000. Similar, so this entry is similar to that, expense account debit to parties account 15,000. And during the year 1920, payment is not made. During the 1920, payment is not made. So can you tell me whether the expenditure is more than 10,000? Yes, expenditure is 15,000. So condition 1 is fulfilled. Condition 1 is fulfilled. What about the second condition? Second condition cannot be checked. Second condition, it is not possible to check itself. Why? Because you have not made the payment now. If you have not made the payment, how do we check the second condition? So it is not possible to check the second condition. So what is the consequence? Expenditure deduction will be allowed to you. Deduction will be allowed to you in the previous year 1920. While calculating the income of previous year 1920, deduction will be allowed to you. Is that very, very clear? Now the further part says, in the next year you have made the payment. In the next year you have made the payment. So what entry you will pass? Manoj's account debit to cash account. Manoj's account debit to cash account is the entry passed in the next year to make the payment of a credit transaction. So can I say payment is made by other than account paycheck, other than bank draft, ECS, etc.? Yes, payment is made in cash. What is the amount paid? Is it more than 10,000? Yes, it is more than 10,000. See what has happened now? The case 2, expense and payment both are in the same financial year. Sorry, case 1, expense and payment both are in the same financial year. Case 2, expense is incurred in 1 year, payment is being made in the next financial year. So in that case, condition 1 can be checked in current year and condition 2 can be checked in the next year. So condition 2, we can say that condition 2 is complied in the next year. So what will happen? We have already given you deduction while computing income of the year 1920. 1920, you have debited the expense, you have debited the profit and loss account. We have already given you the deduction. So what we are going to do in the next year? In the next year, when you make payment in cash, we'll say that section 48(3) is not complied. Therefore, the amount which you have paid in cash now, that amount will be added to the income of next year. The amount will be added to the income of next year. So what will happen? Amount will be disallowed. In which year? 2021. 2021 it will be added to income. Have you understood the second case? Yes? Have you understood the second case? Second case, disallowance is applicable in the year of payment. Second case, disallowance is applicable in the year of payment. Now, first case, expenditure and payment were made in the same year. Second case, expenditure is incurred in the current year, payment is made in the next year. So, in the current year, while calculating income, we will allow the deduction. In the next year, when you make payment by violating the section, we will add that amount to income and we will disallow. It will be added to the income. So, that is the second case. Second case is done. Now, friends, let's move on to the last case, that is case number 3. Case number 3. Previous year 1920, you have passed an entry, advance to Mr. X account debit to cash account. Previous year 1920, you have passed an entry, advance to Mr. X account debit to cash account. So, can I say you have made a payment of 15,000 in cash? Yes. Can you apply section 48(3) and disallow 15,000? No. Why? Because this is not an expenditure at all. This is not an expenditure. This is the balance sheet entry. Advance to Mr. X, this account will get reflected in the balance sheet asset side, and the cash account which is credited, that will also be reflected in the balance sheet asset side. I am not going to debit my profit and loss account in this year because both the accounts involved in the entry are a balance sheet accounts. It will not impact my profit and loss account. If it is not debited to my profit and loss account, I am not claiming deduction. If I am not claiming deduction, where there is a question of disallowance. Question of disallowance would arise only if I am claiming deduction. Na? If I am not claiming deduction, how can you disallow? Nothing can be disallowed. So in case 3, previous year 1920, that entry is not an expenditure, therefore there is no tax treatment. No tax treatment means there is no question of disallowance. Now comes the previous year 2021, and in previous year 2021, say for example, you have purchased some goods from Mr. X, or Mr. X has given you some services, and against purchase of that goods or purchase of services, you should make the payment. But instead of making the payment, whatever advance you had given to Mr. X, you are adjusting that advance in the current year. You are adjusting that advance in the current year. So you have passed an entry, expense account debit to advance to Mr. X account. In that case, this 15,000 will be disallowed to you in the year 2021. Why na? Because the amount of expenditure is more than 10,000, and against this expenditure you are adjusting what? You are adjusting the advance. And advance was made in what manner? Advance was given in cash. So basically, if you look at the second case as well as the third case, if you combine the entries of both the years, in the second and the third case, the net entry itself is nothing but expense account debit to cash account. Net entry is nothing but expense account debit to cash account only. So first case, entry is expense to cash. Second case, two entries are passed, but if you combine the entry, the effect is nothing but expense to cash. Third case also, if you combine the entry of both the year, that would give you the same thing, expense account debit to cash account. In that case, in third one, we say that disallowance would be applicable in the year 2021. So I have taken three different cases, and the purpose of taking three different cases was to make you understand in which year disallowance would apply. Okay. So at the end of the section, I have a summary of the section. At the end of the section, I am having a summary of the section. Look at the summary. Day before examination, just refer to the summary. Once I have taught this everything in the class, you refer it once, thereafter you just refer to the summary of the section. Point 1 says what? Payment is made by account pay, check, account pay, bank draft, ECS and other electronic mode. See, if you make payment by account pay, check, account pay, bank draft, etc., there is no restriction. Section will not apply. Section will not apply means deduction is allowed for the expense irrespective of the amount. Deduction will be allowed. Whatever may be the amount of expenditure, deduction will be allowed. Second possibility, if the payment is made by any mode other than account pay, check, other than bank draft, other than ECS, etc. In other words, payment is made in cash or by cross check or by bearer check. In that case, if the amount per expense, per payment, per day, per person, apply four parameters: per expense, per day, per person, per payment. Per expense, per payment, per day, per person. Apply the four parameters. If per expense, per payment, per day, per person is less than or equal to 10,000, then nothing will be disallowed. On the other hand, if per expense, per payment, per day, per person, if that amount is more than 10,000, then entire amount will be disallowed. If that amount is more than 10,000, entire amount will be disallowed. This is the summary of the section. Now I want to add the last point here. Throughout the section, the amount which was applied was 10,000 rupees. So if the expenditure is more than 10,000, payment is also more than 10,000, and the payment is either in cash or by cross check or by bearer check, then it was being disallowed. But in case of transporters, means SSC who are engaged in transportation business, the amount of 10,000 is not required to be applied. Instead of that, amount of 30,000 should be applied. 35,000 should be applied. Instead of 10,000, amount of 35,000 should be applied. So in case of transporter, when you make payment to a transporter, when the payee is a transporter, not the payer, payee is the transporter, when we are making payment to the transporter, instead of 10,000, 35,000 amount should be applied. So when I make payment to transporter, if the expenditure is more than 35, payment is also more than 35, and the payment is made in cash or cross check or a bearer check, then entire amount will be disallowed to me. Entire amount will be disallowed to me. Thank you very much. Thank you very much.